Welcome to all of you to the 2021 conference of the International Capital Market Association. Before we begin, I would like to thank our sponsors for this event: Bond Radar, Citi, Convex, the European Investment Bank, Euroclear, Euronext, Intesa Sanpaolo, JSDA, Luxembourg Stock Exchange, and the Vienna Borsa. Your support is very much appreciated. I would like to start by observing how truly remarkable it is that I am speaking with all of you virtually today. First of all, it's been roughly 2 years since I was last able to deliver opening remarks at an annual ICMA conference. Last year's event was canceled, as were many others, due to the pandemic. It was the first time in more than 50 years that we were not able to run our annual conference. And I know I'm not alone in saying that I truly missed it. I missed being able to talk to our members and industry participants and to engage with our speakers and panelists face to face. And now, 1 year later, we are still living with the impact from the pandemic. We are running a conference this year, which is terrific, but we're having to do so in a virtual format. So we will be able to experience some of what has made our conferences excellent in the past, our speakers and panel discussions, but we will still miss out on the opportunity to meet each other in person. Hopefully, we'll be able to do so at this time next year, if not sooner. In the meantime, thank you all very much for demonstrating your support by attending today and for your continuing involvement in the work of the association over the course of the last 2 years. As we've made our way through the different phases of the pandemic, our industry has shown great adaptability and resilience, as have the individuals who work in it. The ability of all sides of the market to work effectively from remote locations for extended periods of time across multiple jurisdictions around the world is a remarkable achievement. As I'm sure we will hear from some of the speakers and panelists today, there is bound to be some impact on how all of us think about the workplace going forward as a result. One of the beneficial effects of the industry having to find ways to work remotely is that through virtual platforms, we can host an inclusive and truly global audience at our events. That is certainly the case today, as we have participants plugged into our conference from all parts and all regions of the world. Throughout the past year, we have taken full advantage of this technology to extend participation in our meetings and events as widely as possible. It has been an honor to serve as chair of ICMA during this period. I can definitively state that the work of the association has not slowed down, and I am incredibly proud of what our organization has been able to accomplish over the past 12 to 18 months. If anything, our work has accelerated during this time, especially if you measure it in terms of new members joining, consultations responded to, reports published, an increasing number of international meetings and conferences in which we've participated, and the number of requests we receive for our advice, which has also increased, and our involvement in industry and regulatory initiatives. You'll be hearing more about this work in greater detail as we dive into the conference agenda today, with reports from our market committees on the achievements and concerns of our major constituencies across the primary and secondary markets. I'd like to highlight just a few areas of focus, which you will see reflected in today's conference sessions. First, ESG and sustainable finance. The dramatic surge in interest and activity in sustainable finance and ESG more broadly is one of the dominant trends to emerge from the pandemic year. 2020 was a remarkable year for green and sustainable bond markets, with over $590 billion in new issuance globally. And issuance of social bonds also significantly increased, even briefly outpacing green bond issuance as funding was raised to meet the socioeconomic issues caused by the pandemic. We expect levels in both types of financing to continue to increase in 2021, with the potential to reach new record levels. Since our last conference, ICMA has launched 2 new pieces of guidance for the market: the sustainability-linked bond principles in June of last year, and the Climate Transition Finance Handbook in December. In addition to the green and social bond principles, we expect both of these to contribute meaningfully to the overall development of markets in this space. And speaking of the GBP, at the recent Green Bond Principles AGM that took place last month, we launched the first update to the principles since 2018. This is important as it will ensure that the GBP continues to reflect the ongoing change and evolution we are seeing in this space. Moving into the second item, fintech developments. I've already mentioned the industry's successful move to embrace and leverage remote working over the past year and a half as a response to the pandemic. Obviously, this would not have been possible without technology. Just as the pandemic has increased momentum in ESG markets, we expect the same in relation to technology and market-related innovation. All of us in the industry are seeing the push from all sides of the market towards automation, transparency, and access, all of which provide opportunities for broader change in financial markets. Today's conference will include a session on fintech developments across bond markets to address some of these issues, and I'm sure this topic will come up in other sessions as well. Moving into my third item, our geographic focus. We continue to focus closely on the needs of our core membership in Europe and on maintaining constant, close dialogue with European regulators. We continue to view this connectivity to be of paramount importance for us at ICMA as an association and for our members. To underline this, for the first time in the association's history, we now have an office in Brussels, which we opened last month. We are definitely excited about this addition to our continental European locations. At the same time, although our foundation is as a European association, we have always recognized that markets are global. I would therefore like to briefly highlight the ongoing work we've been doing in the Asia-Pacific region. It's apparent from the levels of visibility and engagement of our Hong Kong office and from the growing number of members in the region that the energy and dynamism that we see in bond markets there will be a source of growth and innovation for the future. We are pleased that we've been able to be involved in creating the frameworks that have enabled this international expansion and look forward to continuing to build on the relationships that we've established. The conference and AGM provides an opportunity for us to review our achievements over the past year, but more importantly, it provides us with an opportunity to see what those achievements might be able to tell us about the future. Our final panel of the conference today will be our panel of industry leaders. During this session, we will consider some of the major trends we are seeing today, which are likely to shape markets over the next few years. I've mentioned some of these in my remarks this morning. They include the pandemic and its impact economically and otherwise, the return to normality around the world, whatever that may ultimately look like, and the emerging theme of sustainability and ESG over the past year and its implications for the future. I'm sure we are bound to touch on digital finance and fintech in there as well. Finally, I do hope you will stay with us today after the formal sessions end. There will be additional networking time provided through the platform that we're using. Thank you all once again for your support of ICMA and for attending today's conference. With that, I'd like to introduce our first speaker. To start our conference today, we are absolutely delighted to welcome Mairead McGuinness, European Commissioner for Financial Stability, Financial Services, and the Capital Markets Union, who has served in that role since October 2020.
A very good morning. I'm delighted to address the ICMA annual conference today. As we all know, the past year has been extremely difficult. And during this pandemic, the COVID-19 pandemic, we've seen some of the weaknesses of the European economy exposed once again. European capital markets aren't developed enough and aren't providing the necessary sources of non-bank funding. If we look back to the last crisis, we saw how the US recovered more quickly than the European Union, in part due to more developed capital markets. But I'm happy to say that we can and we should be optimistic for the future. With the vaccination campaigns, Europe is opening up again. And the EU is helping globally as well through contributions to COVAX to provide vaccines across the globe. After the dark days of the peak of the pandemic, which caused so much death and illness, we can now look forward towards the economic recovery. And this is a time to think about the society and economy that we want to build, looking towards the future, not harking back to the past. The European Union is investing to build a lasting, prosperous and sustainable recovery. In particular, we're harnessing the EU's budget. We have a new instrument, Next Generation EU, which will provide €750 billion to spend on the recovery. And for the first time ever, the Commission will borrow from financial markets and channel these funds to EU countries. The Recovery and Resilience Facility is the main part of Next Generation EU. It will provide large-scale financial support to reforms and investments undertaken by national governments. It aims to mitigate the economic and social impact of the pandemic. At the same time, it aims to use the opportunity of this huge investment to make European economies more sustainable, resilient and better prepared for the green and digital transitions. Some 37% of Next Generation EU will be spent on climate-related projects and 20% on digital projects. We can invest in the rollout of 5G, grid infrastructure or AI. And we can invest in renewables, sustainable transport, energy-efficient buildings. This is a powerful tool for the transformation of the European economy. Preparing for the recovery is not just about investment. It's also about how our broader policy aims can contribute. And one of our flagship initiatives is the Capital Markets Union, to create a single market for capital to benefit consumers, investors and companies, regardless of where in the European Union they're located. Advancing the Capital Markets Union can contribute to the recovery by providing deep, liquid, integrated capital markets. And that will widen access to alternative sources of funding for our companies beyond bank loans. It will give people more opportunities and confidence to save and invest for the long term. The Capital Markets Union is also about mobilising the investment we need to meet our ambitious European Green Deal targets. It will help capital flow across the EU, including towards sustainability. The European Union strongly supports the transition to a low-carbon, resource-efficient and sustainable economy. And whether it is climate neutrality by 2050, biodiversity targets or fighting single-use plastics, the European Union is leading the way. And we're also leading the way on sustainable finance. Our focus is on ensuring that investment supports a sustainable economy and a sustainable recovery. Public money, including Next Generation EU and national funding, will help. But private money is essential to help us achieve our targets. So we want to help channel private investment into the transition to a climate neutral, resilient, resource efficient and fair economy. On April the 21st, the European Commission adopted a sustainable finance package, providing some more vital tools to help the financial system become more sustainable. The first part of this package was the first ever list of economic activities that contribute to our climate goals as part of the EU taxonomy. This taxonomy for environmentally sustainable economic activities is a world first, the world's first green list. And it translates the EU's green goals into practical criteria for investment purposes. This taxonomy protects private investors from greenwashing and investment losses due to stranded assets. It will help companies to plan their transition. It will help financial companies to design credible green financial products. And ultimately, the EU taxonomy helps to shift investments to where they're most needed. The list of activities that contribute to our climate goals cover a wide range of economic sectors, covering roughly 40% of listed companies in sectors that are responsible for almost 80% of direct greenhouse gas emissions in Europe. And this includes sectors like energy, buildings, transport and insurance. The EU taxonomy is a living document and we will continue to develop it. For example, we will add activities that make a big contribution to our other environmental goals, such as combating pollution and supporting biodiversity. The second part of our April package is a new corporate sustainability reporting directive. This will increase transparency in European markets by improving the clarity and reliability of company reporting on sustainability matters. It will also ensure that financial market participants have the necessary information for their own sustainability disclosures in line with the disclosures regulation. Finally, the Commission also adopted implementing regulations on sustainability preferences and fiduciary duties. They will make sure that financial firms include sustainability in due diligence procedures and in their investment advice to clients. And this will help investors to make informed decisions in line with their climate and environmental preferences. Right now, the Commission is working on a renewed sustainable finance strategy, which we will present later in the summer. And this will set out a roadmap for sustainable investment to support the European Green Deal. And what we want to do is empower companies to move away from unsustainable activities and transition to sustainable activities. We want to make sure the consideration of climate and environmental risks mainstream in the financial system. Financial institutions should be taking steps already to reduce their exposure to sustainability risks. We need this renewed strategy to match our more ambitious 2030 and 2050 climate targets in the European Green Deal. The Commission will also put forward a proposal for an EU Green Bond Standard based on the EU taxonomy. And the aim is to create a gold bond standard based on market best practice, available to all green issuers on a voluntary basis to support a high-quality market in green bonds. To accelerate the green transition, we need to work together at a global level because the climate challenge is global. In October 2019, the European Union launched the International Platform on Sustainable Finance to allow policymakers to work together on sustainable finance and to combat fragmentation. Its members represent over half of the world's emissions, GDP and population. And we look forward to continuing this global cooperation as we look towards the next climate summit, COP26, in Glasgow in November. So let me close by highlighting that the underlying aim of our work is to accelerate the transition in the wider economy and to boost sustainable investment. As we invest to recover from the COVID crisis, we have a chance to make sure our money helps us move towards a greener future. Thank you for your attention.
Thank you very much, Commissioner. Sustainability and sustainable finance in particular are at the heart of what we are doing at ICMA. We are very glad to have been involved in the development of the EU Sustainable Finance Strategy, the taxonomy, and the Green Bond Standard. ICMA Chief Executive Martin Scheck will now share with us his review of ICMA's activities and achievements over the last 12 months.
Thank you, Mandy, for that kind introduction, and many thanks indeed to Commissioner Mairead McGuinness for those comments. And let me also welcome you to today's conference. In my remarks, I'd like to provide a brief summary of ICMA's main activities and developments over the course of the last year. Step by step, we are emerging from the depths of the pandemic, but unfortunately, the easing of restrictions did not come in time for us to organize and hold a physical AGM and conference. So again this year, we had to adopt a written AGM similar to last year to transact the formal business, and this took place earlier today. And as you can see, we're holding a virtual conference now. Hopefully next year, we will be able to hold an in-person AGM and conference in Vienna, also taking advantage of the developments in video conferencing to ensure that it's as widely accessible as possible to those who can't be there in person. This time last year, we were in the midst of the pandemic, and I, for one, was not expecting that a year on, we'd still largely be working from home, that almost all meetings would still be virtual. The easings last summer in many countries led to limited reopening of our offices, including our new London office at 110 Cannon Street. But this was sharply reversed by the renewed waves of infections in the autumn, when all ICMA staff reverted to remote working. And this is still generally the case, except for our Hong Kong office. Coping with the pandemic has involved us all in embracing new technology, requiring us to develop different skills and techniques. ICMA, like many other entities in the financial services industry, adapted early and well. This enabled us to remain efficient and effective during the remote working period. But now that the vaccination programs are well advanced in each of the countries where our offices are located, we are looking forward to a time where we can use them again more normally with the resumption of social contact and face-to-face meetings. In fact, the period since our last AGM has been extraordinarily productive for ICMA in all respects. Our engagement with members has been intense, our committees and councils well attended and highly focused on dealing with topics of relevance to members. Wherever we can, we bring together our sell side, buy side, and other members to represent the market as a whole. Interaction with regulators, both bilaterally with members and in various outreach and expert groups, has been extensive. Our output, whether in terms of market practice guidance, regulatory advocacy, responses to consultations, research papers, market commentary, webinars, podcasts, or other events, has been at the highest level I've seen during my period as Chief Executive. Additionally, we're delighted to have opened a representative office in Brussels to recruit the first person to work in that office. Following the end of the post-Brexit transition period, it's clear that we need to engage in parallel with the EU authorities as with those in the UK. And this new office, which reinforces our EU footprint, will be helpful in that regard. As you're aware, we continue to be heavily engaged in the transition from LIBOR to risk-free rates from the perspective of the bond markets. This is a complex transition, and since the last AGM, much of our attention has been on promoting the adoption of the new rates in the bond markets, which has largely gone well. More recently, the emphasis has shifted to identifying and dealing with the specific issues around tough legacy in order to ensure an orderly wind down of LIBOR. International coordination of the process is also a challenge, and the issue is becoming particularly acute given important deadlines at the end of this year. This remains a major ongoing issue for ICMA, both in Europe and Asia. We've undertaken a series of webinars to audiences to raise awareness and share information, and this includes a webinar highlighting our recently published paper on tough legacy issues in Asia Pacific. And you can be assured that we will continue to work intensively with our members and with the official sector stakeholders to facilitate an orderly transition. There are two other themes cutting across all our activities. Firstly, fintech. Our fintech activities increased substantially during the year, guided by our new Fintech Advisory Committee. We have published and keep up to date directories of relevant fintech solutions in each of our core areas of activity, and these are a unique resource for members in the debt capital markets. Our agenda is focused on harmonization and standardization, digitization and tokenization, while simultaneously deepening and broadening our regulatory involvement. An important current initiative is a common domain model for repos and bonds. This is a digital representation of the life cycle events of these financial products and will shortly conclude the first phase of committing these to software code, working with a third-party software company. The initiative is a building block for the digitization of capital markets, facilitating the use of smart contracts and creating future efficiency benefits for members. The other major global theme, of course, is sustainability, and you'll have seen throughout the year the many publications and guidance documents we've published. Central to our work is the development of the sustainable bond markets through acting as a secretariat of the Green and Social Bond Principles. This is a major global initiative, and over 95% of sustainable bonds follow ICMA standards. The sustainable bond markets are mainstreaming, social bonds saw explosive growth in 2020, and the green bond market is running at record pace. We've also been at the forefront of the climate transition finance discussions, and in this context launched the sustainability-linked bond principles in 2020, and late in the year published a climate transition finance handbook. We held the 2021 AGM of the Green and Social Bond Principles in June and released an update of the principles as well as supporting documentation. The revisions were designed to provide a higher level of transparency for investors, to provide input on the KPIs of sustainability-linked bonds, a useful pre-issuance checklist for social bonds, and additional guidelines on impact reporting. Sustainability touches every element of ICMA's work. For our issuer and asset manager members, the planned new regulatory ESG disclosure requirements are very challenging in terms of scope, scale, timing, and complexity. At ICMA, we're helping to ensure that the regulations are practical, well-designed, and achieve their goals. Through our involvement on the EU's platform for sustainable finance, through our work with Asian regulators and those from other regions, we have an unobstructed view of developments globally, enabling us to share our and our members' views to good effect. An example is in Japan, where we've had significant interaction with the Japan Financial Services Agency and the Ministries for Economy, Trade and Industry and the Environment, as they created the basic guidelines on climate transition finance. This explicitly references our Climate Transition Finance Handbook. We're also pleased to work with the Ministry of Economy, Trade and Industry to host a well-received seminar promoting transition finance and explaining these new Japanese guidelines. And we can also point to significant other examples in ASEAN and in China. Let me also highlight some of the research papers written this year, such as on green and sustainable finance, what's the role of the repo market? This responds to a desire to bring sustainability to the whole financing spectrum of an entity, including the short-term funding markets. The paper looks at the role of repo in sustainable finance, asking questions and exploring views prior to formulating a position and possibly providing guidance. Similarly, a comparative analysis of the main national and regional taxonomies entitled Overview and Recommendations for Sustainable Finance Taxonomies compares major taxonomies and provides advice in terms of common principles for the creation of new ones. And further convergence is certainly desirable. Our flagship publication is the ICMA Quarterly Report, containing articles and updates on all our work streams. You may have seen our ongoing commentary on the post-Brexit trade negotiations, the market impact of the end of the post-Brexit transition period when the single market became two separate markets, and the remaining challenges for the financial services industry, given what has largely been a no-deal Brexit for the industry. Covered extensively in last year's quarterly reports are updates on the many market practice and regulatory initiatives we've been involved with, such as the ongoing MiFID II MiFIR revisions, the proposals for a future bond consolidated tape, and a review of our work on the problematic proposed mandatory buy-in regime for bonds under the CSDR. Another industry-leading initiative since our last AGM was the implementation of the SFTR for the repo market, a massive undertaking with implications far beyond the EU. In the event, this went smoothly and is now largely implemented and behind us. The primary markets were exceptionally active last year, with record issuance in almost all segments as borrowing requirements rose in the wake of the pandemic. Most international issuance follows the guidelines set out in our primary market handbook, and we ensured that these were kept up to date and also reflected necessary changes as a result of the end of the post-Brexit transition period. Our primary market issuer constituency, our Public Sector Issuer Forum, Corporate Issuer Forum, and Financial Institutions Issuer Forum, our primary underwriters, and the associated transaction managements are an exceptionally active and engaged group. An important role for ICMA is to facilitate the contacts and dialogue with the investor community, key importance in responding to an in-depth consultation by the Hong Kong Securities and Futures Commission on primary market practices earlier this year. Secondary market liquidity remains a focus, and we published a review on the functioning of both the secondary bond market and the repo markets during the worst phase of the pandemic. Given the official sector discussions on the efficacy of non-bank financial intermediation sparked by the functioning of the markets during this period, we've since revitalized our commercial paper committee to include issuers and investors, and are now chairing a bond market liquidity committee for IOSCO's affiliate members consultative committee. We published a further study on bond market liquidity in the Asian G3 markets earlier this year, and our Asset Management and Investors Council is finalizing a review of the functioning of money market funds. When the pandemic hit us all last year, we moved into the virtual world. We were concerned that the level of engagement with members would decline and perhaps even ICMA's membership would shrink. But I'm pleased to say that in both cases, the opposite has been true. Our membership continues to grow with new members joining in all categories from all over the world. We have around 600 in over 60 countries. And it's particularly gratifying to see the increasing number of buy-side and issuer members choosing to join. Communication using the many video and audio conferencing tools at our disposal is now second nature, and attendance at meetings and events has actually been higher than when they were purely physical. Clearly, the interaction is not the same, but the reach is greater. This is also the case for meetings with regulators, which happen more regularly and are convened more quickly when travel plans are not needed. The interaction with regulators and supervisors has been particularly active, and ICMA is well represented on the key official sector outreach groups relevant to our markets. Particularly successful has been our series of podcasts, now over 100 since March 2020, and downloaded over 70,000 times. And these complement the many webinars we organize, covering most aspects of our work, again, attracting large numbers of participants from a wide range of countries. Our regional committees have been more impacted by the restrictions on physical meetings than our functional ones, since they're designed not just to be our eyes and ears in the various regions, but also to build the ICMA community in each region. This is significantly more difficult without the opportunity to meet together, but we're very grateful to the chairs of those committees for the imaginative ways they've found to bring their communities together. It'll be a real pleasure to visit them again once travel restrictions are lifted. There have been two structural changes to our region since our last AGM. The former Irish chapter has become a fully fledged region in its own right, and in Africa, we've split the region into South Africa and West Africa, each with its own subcommittee and chair. Important given the diversity of the different countries. We're also grateful to our regional committees for their help in promoting our education courses. As you may know, our offering is currently virtual, either online home study courses or live streaming classes with our experienced trainers. This has gone well, and the suite of courses now offered is very wide, covering all our core areas and many more besides. In addition, we're still running our Mandarin language corporate financing qualification with our Chinese partner, and after a short downturn at the beginning of 2020, this has resumed successfully. Diversity and inclusion have been at the forefront of our minds given the events of the last year, and ICMA has a role to play in promoting equal, diverse, and inclusive practices, both internally and externally. Gender balance is a focus from board level downwards, along with diversity in the hiring practices of all our officers. We strive to build diversity and inclusion into all our events, whether on panels or when we engage speakers. The ICMA Women's Network and the ICMA Future Leaders both continue to provide valuable input. And a particular initiative you may have seen is the ICMA Scholarship Program, which provides education to selected participants from countries in sub-Saharan Africa who would not otherwise have the opportunity to take our education courses. From a large number of applicants, we chose the first cohort of 25 individuals from 7 different countries, and they've started their diploma pathways earlier this year. We wish them well and look forward to selecting the next cohort later this year to start early next. At the AGM, the members were requested to approve the audited financial accounts for 2020, and these present a very positive picture of the operation of the association, with only a small net deficit for the year. This is significantly better than budgeted, largely a result of cost efficiencies during the pandemic and positive member development. The association remains in a robust financial position, and fees, which have not increased since 1st of January 2012, again remain unchanged for 2021. I hope that this short address provides a useful summary of the main activities of ICMA since our last AGM. The agenda has been packed and the level of engagement and activity at an exceptionally high level. None of this would be possible without the support and input of our members, a committed board, and the efforts of hardworking and dedicated ICMA staff. Many thanks to all of you. As a final point, I want to mention that this is the last ICMA annual conference I will be addressing as Chief Executive of ICMA. ICMA's board is currently well through a process to find a successor for my role, and I've no doubt that this will be successfully finalized in the coming weeks with the announcement of a highly qualified new chief executive who can steer ICMA through the next phase of its development. It's truly been a privilege to serve the association and our members as chief executive since 2009, helping to guide ICMA through a period of immense change and expansion, and I've enjoyed it thoroughly. The transition to a new chief executive comes at a time when ICMA is particularly healthy. Record membership, fabulous member engagement, strong regulatory relationships, a clearly defined strategy, and a robust financial position. But this has only been possible with the unwavering support of our members and a marvelous team of colleagues at ICMA. Thank you. Let me now hand the floor to Paul Richards, ICMA's Head of Market Practice and Regulatory Policy. Paul is going to guide us through various conversations with leading capital market practitioners on the key capital market themes impacting our members.
At ICMA, our objective is to ensure that international capital markets are efficient and resilient so that they support sustainable economic growth and development. We do this by working with our members and with regulators to ensure that new financial regulations are consistent with our objective and can be implemented in a cost-effective way, and to set standards of good market practice within the regulatory framework at national level, EU level, and global level. We work through a network of committees of our members, chaired by members. ICMA provides the secretariat. For this session, we have brought together the chairs of some of our key committees and the heads of the ICMA Secretariat with whom they work to discuss critical issues we've been addressing on members' behalf in the recent past and that we expect to address in the period ahead. The issues that we are going to discuss relate to sustainable finance, primary markets from the perspective of issuers, primary market syndication and related legal and documentation work, secondary markets, repo and collateral markets, asset management, and fintech. Finally, we're going to focus on our work in Asia Pacific.
Hello, my name is Nicholas Pfaff. I'm a Managing Director and Head of Sustainable Finance at ICMA. I'm also the Secretary of the Green Bond Principles. I'm very pleased to be here today with Denise Zodaro, who's the Head of Investor Relations at IFC, but she's best known to us for her work as Chair of the Green and Social Bonds Principles Executive Committee, which we refer to as the EXCOM. Denise, welcome.
Thank you very much, Nicholas, for having me.
Denise, to start our conversation, I wanted to ask you to describe the work that you do with the Executive Committee, with the market initiative behind the Green and Social Bond Principles, which I think involves now more than 400 members and observers.
From the inception of the concept of the Green Bond Principles back in 2014, the 4 banks that served as the drafting committee for these principles recognized that diverse stakeholder input was required for the principles to be adopted far and wide. And so now we have issuers such as IFC, as you mentioned. Of course, we have investors as well. And we've come a very long way in the last 7 years in terms of growth of the Green Bond Principles ecosystem. And we now have 3 frameworks related to use of proceeds thematic bonds. And those are, of course, the Green Bond Principles, also known as the GBP, the Social Bond Principles, and of course, the Sustainability Bond Guidelines. But in addition to that, we've also released one framework that expands sustainability from strict use of proceeds to corporate strategy, and that is the Sustainability Linked Bond Principles that was released last summer. I think our challenge, Nicholas, is engineering an acronym to convey, in fact, the family of frameworks that we have, mitigating this alphabet soup that we found ourselves in. But every year, following the annual general meeting of the principals, we do reach out to the over 400 members and observers community, as you said, in terms of getting a feel for what is the market looking like and what are the areas that we ought to focus on for time to come. And I will say that our goal continues to be this, our North Star being what, in fact, can we do to further promote the sustainable bond market?
That's very interesting, Denise. And I think it's important because, we sometimes get the feedback that part of the market thinks that, ICMA goes into a dark room and comes up with these principles. And as you were saying, it's really part of a very wide market initiative. You also mentioned that we've got this whole family, a kind of collection of principles out there. Now, what role do you think that these principles actually play in support of the sustainable bond market?
I'd say that the principles have been extremely beneficial in that market practitioners, draft and govern those principles before they go out the door. So the content in itself passes the feasibility test of issuers, investors, underwriters, and the related bodies that make up the member and observer community. The principles, in fact, I would say are all steps in this journey that we have to make, which is the journey to, of course, a low carbon economy. And we are all aware of what those challenges and risks are. I mean, the physical and financial risks that climate change brings, the degradation of assets that we're seeing, and of course, the rising cost and lack of ability to insure some of these losses. So the sustainable bond universe evolved out of that necessity to adapt our current models to the future path of continued development, but sustainably. And we do this in several ways, as we said. We've designed the principles to provide guidance on 3 levels. One being, the key components required to launch a sustainable bond. Second being to aid investors in ensuring the availability of information that they have to evaluate the environmental and social impact of their bond investments. And thirdly, to assist underwriters by moving the market towards the standard disclosures that facilitate transactions. This year alone, only in May, we've seen 80 billion of issuance of sustainable bonds, which is more than double the volumes in May of last year. Last May was $32 billion. And the growth in sustainable bond issuance has been spectacular this year. I think it's fair to say that since 2014, the volumes of issuance we have seen and the acceptance and growing demand from issuers may not have occurred were it not for the outlines the principles have provided.
We also did as you know, Denise, we did this evaluation of the take up in the market of the principles, and we found that 97% of sustainable bonds issued internationally actually reference the principles. So there really is a global support for this standard. Now, we've mentioned the work of the executive committee. We've talked about this wide market initiative, which supports it. Let's come back to ICMA. How do you see ICMA's role and how important has it been in working with this market initiative?
So ICMA has played a vital role in the growth of the sustainable bonds through the excellent hosting of the principles through yourself and your colleagues. As the secretariat to the principles, you've also been at the forefront of the financial industry's contribution to the development of sustainable finance more broadly, given, of course, we've seen this uptake in the loans world, et cetera. I'd say that it appears to me, in fact, that I would say that ICMA is committed to promoting best practices and disseminating this market information for sustainable finance through the work you do on the principles, but also through active contribution to policy and regulatory dialogue, which you do, of course, you've done this on the G20, the European Commission's TEG, just to name a few. So a huge, very important and vital role.
Denise, thank you very much. Coming back to and I can confirm how committed we are, by the way. Coming back to the sustainable bond market, you've mentioned the growth, we've mentioned the expansion of the principles. where are we all going with this? I mean, what's the future of the sustainable bond market?
So we've done a lot, as you said, and it's quite impressive to see the growth of the market. But we are still only over $1 trillion in issuance, which is barely 1% or so of the global bond market. So there is a lot of room for growth. To achieve the global goals of net zero by 2050, we need to beckon at high emitting sectors to partake in this market. And they can only do that through transitioning, of course, their models, which is what we want. We did release the Climate Transition Finance Handbook in December of 2020, which offers a bridge for these hard to abate sectors to credibly access sustainable bonds. I think that the growth that we will see is exploring this alongside, of course, the social elements which bring about the discussions of a just transition. We've essentially, at least I would say that in terms of medium-term goals to 2030 to achieve the Sustainability Development Goals. And so this is where our focus is in going forward with the ExCom, the new executive committee that comes into office in the next few weeks, is looking at what more can we do beyond what's already done to promote issuance, maintaining, of course, transparency and integrity of the products.
Denise, you mentioned the Climate Transition Finance Handbook. How is that different from the principles? I mean, why don't we have climate transition principles?
I think it's fair to say that in the numerous discussions that we've had externally with a member and observer community and internally, is that the proliferation of labels does not do justice to any of the market-related parties here. There is a continued need for education at every point, explanation of the credit risk, if there is one or not, and what we're trying to do is consolidate. Fragmentation certainly doesn't build to growth in this arena, of course. Hence, our belief is that for a company that is in a hard to abate sector to access a sustainable bond, there already is mechanisms there for them to be able to do so through the green bonds. However, of course, the level of disclosure that is required for such an issuer is much higher. Hence, the Climate Transition Finance Handbook offers that means to enable them to take the steps needed to arrive at the overall objective that we all have, albeit that they are in a higher demanding area in terms of disclosure and transparency required.
Right. So the Climate Transition Finance Handbook is about disclosure and a transition theme, while the principles is more about bond guidance, bond labels, so green bonds, sustainability linked.
Indeed. So the established products we have are the green bonds, the social bonds, and sustainability bonds, which are a combination of green and social use of proceeds. And then, as I'd mentioned earlier, we of course have a sustainability linked bonds as well, which include the corporate commitment to a sustainability goal to the coupon of a bond. Climate transition can actually feed into both of these types of products, both use of proceeds or the sustainability linked. And again, it just provides a higher level of disclosure for such issuers in hard to abate sectors to access use of proceeds or sustainability linked to achieve the Paris goals.
Denise, thank you very much. And I would also like to thank our viewers at the annual conference of ICMA.
Hello, I am Katie Kelly. I'm the Senior Director in Market Practice and Regulatory Policy at ICMA, and I provide secretariat services to our ICMA Corporate Issuer Forum and our ICMA Financial Institution Issuer Forum, each of which is comprised of the heads of funding of some of the biggest corporate and financial issuers in the Euro markets. It's my pleasure to be joined today by Maureen Baker, who is the Global Head of Funding and Capital Markets at ArcelorMittal, and is also a member of the ICMA Corporate Issuer Forum and Steering Committee, and Peter Green, who is the Head of Senior Funding and Covered Bonds at Lloyds Banking Group, and is also a member of the ICMA Financial Institution Issuer Forum and Steering Committee. So thanks, Maureen and Peter, for joining me today. Starting with you, Maureen, it's been a pretty tumultuous 18 months for the markets generally, but in particular, how do you think corporate issuers have fared over the last 12 or 18 months, particularly in the face of post-Brexit dynamics and the challenges imposed by COVID-19?
I think that they fared very well, in fact. I recall 1 year from today, one of the primary topics at the Corporate Issuer Forum, maybe not 1 year from today, but in June of 2020, a very important key topic for us was COVID-19 disclosure of the risks surrounding COVID-19, as well as, so for the company, as well as for the execution of capital market transactions. And in fact, some very major, important, innovative transactions were executed in this time period while working from home. Brexit, there was very little, there was no disruption in the market as far as issuers were concerned, to the very best of my knowledge. And so I would say overall we fared well, especially while taking into consideration the fact that we were all working from home.
Thanks. And Peter, what about on the financial institution side?
I think a sort of similar experience to the one that Maureen's outlined. I mean, certainly we've had to adapt to how we work and new ways of working. And I think we've all been pleasantly surprised how efficient some of the system adaptation has been. I think from a UK, certainly from a UK bank perspective, and echoing Maureen's comments again, Brexit was sort of seemingly a non-event. I mean, we got through the end of 2019 with limited impacts from Brexit itself, and over the course of sort of 2020 and sort of 2021, we've seen the gradual re-engagement of European investors to UK credits, and hopefully we've seen the end of the dreaded Brexit premium as a concept for UK issuers. I get COVID-19 was clearly the big story of 2020. We all had to deal with huge market gyrations in terms of spreads, but thankfully credit markets continue to function pretty pragmatically, albeit at spreads that we didn't necessarily want to be issuing at. We did have to deal with high levels of investor sort of queries around impacts from lockdown, the economic impacts of COVID-19 and how it was impacting our balance sheets. And I guess one of the main changes over the past 12 months has really been some transformational impacts on balance sheets, certainly bank balance sheets, where we've seen high levels of deposit inflows. We've seen government support schemes in place for liquidity, and overall amounts of wholesale funding needs from bank balance sheets being much reduced, which certainly clearly creates sort of challenges and opportunities for the coming years.
So not necessarily any interrupted access to funding and generally continuity so far over a very difficult period. Peter, staying with you, if I may, what do you see as the big topics or challenges or opportunities for the financial institution issuer community when you look ahead to the next 12 months?
Yeah, it's a good question, and I sort of struggle to sort of see beyond a topic that's certainly very close to your heart, and certainly very close to my heart. But LIBOR and LIBOR discontinuation clearly is going to be a big challenge for the market. I think certainly from a UK market perspective, we've seen a huge amount of progress to date, but there's still work to do, and sort of clearly a big push from issuers and from benchmark authorities and sort of market-wide effort to make sure that we achieve the transition targets at the end of 2021. Other sort of challenges, certainly from a bank balance sheet perspective, there's There's a number of sort of regulatory sort of changes, particularly around risk-weighted assets that could create headwinds in 2022. And then looking more broadly, sort of clearly inflationary pressures within the market. It's a key theme for today. And I guess how that translates into impacts on credit markets and funding markets, we'll see. Fingers crossed that markets continue to be pretty sort of stable and pretty functional over the next sort of 12 months or so. I think sustainability clearly is going to be a topic that continues to be close to issuers and investors' hearts. I think as a bank issuer, we're particularly focused on developments in sustainability bonds, and there's one or two structural challenges that we may have to overcome for bank capital and MREL sort of transactions if we want to pursue sustainability bonds as a viable funding tool. But overall, I think there's lots of opportunities for issuers. Sort of clearly, continued positive conditions, for credit markets will be beneficial. But obviously, lots of positive opportunities to engage with investors around I guess hopefully some positive trajectory in terms of opening up from lockdown, economic growth and a little bit more prosperity than we've become accustomed to speaking about over the last 12 months or so.
So quite a positive outlook, really. And Maureen, does this all resonate with you, or do you foresee a different landscape for corporate issuers over the next 12 months?
No, I would echo what Peter has had to say. So for corporate issuers, clearly liquidity and transparency will be very important going forward, and regulation will be very important for us. And ICMA, we look to ICMA really for a lot of help in that area, and a lot of education. And for me, since joining ICMA, I can be a little bit more relaxed about regulation because I know that you will keep us updated. And then, the market outlook is very good. And most importantly, I would repeat exactly what Peter said with regard to sustainability. So I think that is a huge global mega trend. And I believe that issuers will be navigating their way around green bonds, transition bonds, sustainability linked bonds, use of proceeds bonds, general corporate purpose bonds, ESG disclosure. This will be a very big area for us.
Okay, good. Well, Peter and Maureen, you're both very fully embedded in ICMA's work, generally via your respective issuer fora. But can you perhaps explain how ICMA's issuer community generally has engaged with other ICMA stakeholders and influenced day-to-day work over the past year or so? Maureen, can I start with you?
Sure. So the first thing that comes to mind is, of course, the Sustainable Finance Committee, which brings issuers together with banks, investors, etc. So that has been a really fantastic engagement for us. On top of that, there's also the commercial paper. So European commercial paper and issuers have had a chance to engage with the other issuer forums and the banks, investors, etc. So that's been very helpful. And also the third area is fintech, which is a really interesting area for the corporates. I don't think we're nearly as knowledgeable as the financial institutions are in this area. So that's that engagement has been interesting for us.
Okay, great. And Peter, from your perspective?
Yeah, I think it's, sort of clearly, ICMA is, it's very proactive across, a range of areas. I think, most notably to me, it's going back to the LIBOR transition issue. So clearly, yourself, Charlotte, Paul, being, instrumental in the progress that's been made on, LIBOR transition from a bond market perspective. I think there's a huge amount of pride that can be sort of taken from, the work that has been done and continues to be done, and sort of just drumming up the enthusiasm that you bring to the committees and sort of keeping the engagement levels very, very high. So clearly, it's a hugely important area that we're all focused on. But I think it's been it's really to the credit of the ICMA team that as much progress has been made to date.
Well, thank you both very much for your kind words. And I think that concludes our discussion with the issuer constituency. So thanks, Maureen, and thanks, Peter. And thank you to those who are watching.
Hello, I'm Rory Ewing, Secretary to the ICMA Primary Market Practice Committee. I am joined today by Mark Lewell of JP Morgan, Chair of the ICMA Primary Market Practices Committee, and also a board member of ICMA. I'm also joined by NatWest Markets' David Hopkins, Chair of the ICMA Legal and Documentation Committee. We will talk briefly about current themes for bond underwriters. Firstly, Mark, can you comment on the state of the primary markets and market dynamics over the past year?
Well, great to be here, Rory. The first thing to comment on, which is stating the obvious really, is how strong, robust and flourishing the primary markets have been over the last year. I think if any of us had asked ourselves in the first couple of weeks of the COVID crisis how strong the markets would be, how reactive the primary markets would be, we'd be very surprised by the outcome we see right now. Last year was a record year in volumes in most markets, and surprisingly, this year is following through with very robust numbers as well. And what's particularly impressive is this has taken place while we've all adapted to new working procedures, working practices. We've always assumed, especially on the investor and dealer side, that working in a busy trading floor is an essential part of the new issue process. And it turns out that in extremis, we can manage many of the parts of the new issue process, both on the investor side and the dealer side and the issuer side from a home environment. And we've managed to keep the markets open and active and busy, in fact, with those new practices taking place.
Thanks, Mark. And David, what have been the major topics or issues from a DCM legal practitioner's perspective over the past year?
Thanks, Rory. Yeah, well, I would also pick on the pandemic, of course. And I think that the debt capital markets and the legal community responded very well in the opening stages of the pandemic in last spring. And particularly thinking of the response, for example, to the CCFF scheme, the England scheme, which required great speed and efficiency from banks and from law firms, etc., to get established many dozens of commercial paper programs under the Bank of England scheme in very, very short time, and was done very well and very efficiently overall. So I think that was very good. But there have been other impacts of the pandemic as well, and ICMA has helped member firms with this, for example, with electronic signing of documents, which went from being, pretty unheard of to being commonplace almost overnight, as well as sort of COVID-19 disclosures in marketing materials and comfort on financials in this unsteady financial market. I'd also pick out a couple of other things which were big for the legal community. One was the end of the Brexit transition period. And again, I think the fact that has gone so smoothly from a legal perspective is testament to the work done in advance by member firms, guided by ICMA, especially around standard language on selling restrictions and legends, again, for marketing documents, and having that in place ahead of the game was very important for us. So I think, again, that was well done by the legal community. And I would also mention ESG and sustainable finance, again, which has really come out of the niche market into the mainstream, and a lot of legal work obviously ongoing on that in terms of, again, disclosure, due diligence and underwriter protections. So I would pick on those three elements, Rory, and echo what Mark said. Legal work is something which we've been able to do pretty well from our home environment. So to that extent, it's been not a bad experience.
Thank you, David. And now, Mark, how has ICMA's syndicate community engaged with stakeholders and related to our day-to-day work over the past year?
Well, Rory, I think we've worked together as a community and with ICMA support on many topics over the last year, in particular around the Brexit transition and continuing to implement many of the changes related to MiFID II. But the one that stands out is implementing a new allocation justification recording process, which is something that ICMA and the syndicate community, along with the regulators, have worked on over the past year. That's a process that was ongoing from 2019, and notwithstanding the pandemic, we brought those new practices into the market in the latter part of 2020, and they're now very much normal market practices being used across the European time zone, and it's great to see that taking place.
Indeed. Thanks, Mark. And David, from the legal perspective.
Well, Roy, I think that, the debt capital markets has always been a very collaborative market, one of its attractions for me. And I pick out the work of the Legal and Documentation Committee, which has over 20 member firms on it. There's also a wider circle with another 20 firms, and we have working groups. And this is a tremendous focal point for member firms to get together to meet and discuss matters which affect the industry as a whole. And I mentioned earlier about how important it's been in terms of efficiency and time saving and cost saving to have had that work of ICMA there in producing the standard language, for example, for Brexit transition. And I would like to call out the great work which is done on behalf of member firms and ICMA by law firms such as Linklaters, Allen and Overy and Clifford Chance, which is a tremendous asset to us all. And I think the last thing I would point out was the great access which ICMA gives member firms in terms of access to regulators, especially at this time of such change. So, for example, liaising with the UK authorities on the UK listing review, or with MiFID II product governance review, that sort of thing is a tremendous help. So we've seen a lot of that collaboration, particularly in the last 12 months.
Yeah, no, indeed. Thanks, David. And I suppose moving on, and looking forward, Mark, what do you see as the big topics and challenges for the syndicate community looking ahead over the next 12 months?
Well, there's always something new, Rory, and there's always a new challenge for syndicate, and there was a new challenge for ICMA and PMPC. I think as we look ahead to next year, there will be a reactive element with new things coming up. But in terms of the things we know about, I think the SFC in Hong Kong's new book building code of conduct is something that ICMA has spent a lot of time on with the syndicate community in Asia. The new ICSD syndicated closing process, I think, is something that we'll all want to work together to implement smoothly. And then finally, and David mentioned it before, the biggest topic we've seen really in the last year, this year, and into next year is going to be around ESG. It's a huge focus for all of our issuer clients and our investor clients. And I think as a community, we all are very grateful to the leadership that ICMA has played in helping sort of bring that market to an early part of maturity.
No, thanks for that, Mark. And David, looking forward from the legal perspective.
Yeah, I'd pick up four things, Rory. We keep coming back to it: ESG, sustainable finance. Recent developments there. ICMA is still ongoing in terms of disclosure, underwriter protections, minimizing the risk of greenwashing, etc. That'll be ongoing. Again, as Mark said, the new ICSD's syndicated closings model, it's pretty much been the same for 30 years. So you're looking forward to working across the new issuance community there to realize efficiencies for all market participants from that. I would also pick out regulatory divergence, perhaps going forward. We're going to see in the next 12 months a review of the UK and EU prospectus regulation, and that will be interesting to see how that plays out. And we may also have a review of MAR and of PRIPS. And lastly, perhaps just to mention for electronification of issuance procedures and whether opportunities arise as we continue to look into that.
No, thanks. Well, that was very interesting. And I suppose all I should say now is thank you very much both for participating.
Thank you.
So I'm Andy Hill, Head of Global Secondary Markets at ICMA, and I'm joined by David Kamara, Executive Director, Market Structure and Transition at Goldman Sachs. David has been co-chair of our Secondary Market Practices Committee for some time. Welcome, David. You have been involved with the SMPC and the various secondary market work streams for a number of years now. You've been co-chair for several years. How have you seen ICMA's secondary market forum evolve over that time and engagement with members?
Thanks for the intro, Andy. So yes, I think this has been a very special year, and the SMPC has grown this year. COVID has been the main topic, unfortunately, and when everything went to screens at the beginning of 2020, SMPC helped connect people to people more than ever, I feel. So the role of SMPC in secondary market has been even more prevalent and necessary this year, where we all went home, we all had to work from screens. That connectivity, that value add, connecting to our peers, connecting to buy sides, and talking about subjects that were of concern for all of us was pretty key. And there's a bunch of things we can talk about, like the COVID or transparency or other regulatory topics. But I think it's a very dynamic forum, and I think ICMA are taking it really to the next level, which is very positive.
That's great to hear. And as you mentioned, it's very impossible to ignore COVID when we look back on the last 12 months. Could you elaborate a little bit on how you saw ICMA and the SMPC playing a role in supporting members during that time?
Yeah, I mean, the first thing is the meetings themselves, right? That provided this forum for connectivity where like everyone was connecting less. So I think that's the main topic. But there was also a couple of reports, one specifically on the functioning of the market around this period of the peak of the crisis, and another one, your report on secondary market, which is like the third instance of the report, actually, Time to Act, I think it was called, around March, which was very timely last year. These type of reports on the bond functioning, I think are key, because they help the market understand that fixed income, the way fixed income works. And as we all know, like sometimes regulators tend to want to compare equities to fixed income a lot. And I think all of this work from ICMA, providing reports on how fixed income is very much balance sheet driven, how the liquidity is provided, are like all of these are key pieces of understanding of the fixed income market, and help regulators understand that they're very different animals and that equity and fixed income have to be tackled differently. So yeah, that was a very positive interaction as well.
You also touch on a really good point there about the difference between bond markets and equity markets. And I'd like to ask you about two work streams that ICMA has been involved in, very much at the heart of market structure and how bond markets work. And one is transparency. The other one is CSDR mandatory buy-ins. I'll come back to that. But ICMA has been doing some very interesting work on bond market transparency. I wonder if you could say a few words about that.
Yeah, so I think the main topic there has been the consolidated tape report, and I think the result there was that bond consolidated tape was almost off the agenda of regulators for a while, and I think ICMA have helped bring it back to the agenda. And we're now hearing from the Commission that they will press on having a bond consolidated tape. I think I agree with ICMA there that the truth is there's a lot of transparency coming into the market because of MiFID and other regulations, but the truth is that transparency is not available, is not accessible, and the first step for that to be accessible is actually creating a common place or a CTP. So that has been a great work done by you, by Liz, by the committee, and also responding. The CT report is part of it, but also responding to a number of consultations that are plentiful this year, and making sure we responded with ICMA and with everyone in mind, buy side and sell side. So I think that has been a great job. The complexity around redefining transparency is something that we're currently talking about as well, and that is, as I say, I think the first bit is creating a CTP, and then redefining or simplifying the transparency regime is also something ICMA is very involved in. So I'm very happy with that work, and I think you guys go from the very high level, getting consensus, to the detail, which is what matters here.
The other initiative that I was going to ask you about, CSDR mandatory buy-ins. So until maybe a year or two ago, this was very much discussed within operations working groups. It's suddenly become one of the hot topics, if not the hot topic, for both sell side and buy side traders. Why do you think this is, and what do you think ICMA can continue to do?
Yeah, I know these regs, has a big operational component, but I think the job ICMA has done is trying to connect the dots between the operational component and the front office component of the regulation. And you're right, this has been there for a while. It has been sort of dormant for the last year because it was postponed, but we need to focus on it now. And the truth is, while I think the market welcomes more discipline and better settlements framework, and we all acknowledge that there may be a problem, especially in the more illiquid securities, and especially with periods of volatility. At the same time, there are some components of this regulation that are not straightforward, like there was no pass-on mechanism, the repapering with clients, the having to appoint a buying agent, and there's a bunch of other items that are really worrying the trading community now. And I think ICMA has done a good job at trying to list those items and elaborate advocacy around those, and even create some, or trying to measure the potential impact of a CSDR go live. It looks like it will go live in 2022, and I think there's still a lot more of implementation work to do. And I think we still need to be on top of this particular regulation and work on it. The time is very tight, so I would welcome more engagement on this, maybe for future meetings.
No, definitely, I think this is going to keep us busy probably up until February and beyond. One of the flagship work streams under the SMPC is the Electronic Trading Council, and I'm wearing your market structure hats. That must be something where you've seen a great deal of engagement. I wonder if you could just tell us a little bit about the work that's being done there.
Yeah, Liz has done a great job at trying to put together the buy and the sell side there, and it's a very tricky topic, right? And I think one of the latest products of that has been the guidelines of price dissemination or price distribution. It's a very controversial topic, and it's been out there for a while. Since I was in the sales and trading unit, like the access has been like probably the core as to how the market trades. And I think redefining some guidelines around what's an ask, what's a run, has been controversial, but has been very positive. And the product of it is just a small document. But the truth is, I think the debate it has created and the level of engagement that ETC has produced is actually what is really positive. It was very honest. It was very loud. A lot of people expressed their opinions in an open and honest way, which I think is exactly what trade associations like ICMA bring into the market, right? That openness and that honesty. So I was very pleased with that part of the work this year, and I hope we can continue in that vein in the next year as well.
And I think it's a good example as well of ICMA bringing the market together to outline best practice and in line with our market rules and recommendations. Finally, I wonder if you could maybe just say a few words about, I mean, a lot of the things we talked about are very European focused, but maybe we could finish up by talking about how we're expanding our work into Asia and some of the work we're doing there.
Yeah, sure. So I think, I mean, in terms of expansion, Asia is APAC in general is an obvious region. The volumes there are just gigantic, right? And I think that also the market structure there has a lot of evolution. We've seen with Bond Connect and other initiatives. So I think, I mean, ICMA has published a couple of papers there, one for inshore and offshore, China, and another one for international markets, I think, in Asia. And the more we can help the APAC market develop, and there's a lot to do there, both in terms of volume and I guess also in terms of innovation happening, right? Sometimes it is not necessarily the last market that gets the most innovation, but at the same time, I do think that like the market there is moving pretty quickly. So it may go from like a very manual market like we had in Europe 10 years ago to a very automated market in a very small period of time, right? In 1 year or 2 years. So I think that's one to watch, definitely. And the reports from ICMA are worth reading in that aspect. Yeah, and all in, it's been a busy year, as you see, Andy. Like I think ICMA didn't stop this year, and I'm very keen to keep trying to help in the next year.
David, thank you for sharing your thoughts and insights on the SMPC and our secondary market work, and thank you for your continued stewardship and leadership as co-chair of the SMPC.
Thanks, Andy.
Good morning and welcome to our Repo and Collateral panel. I'm Alex Westphal. I'm the secretary of our European Repo and Collateral Council, the ERCC, and I'm very pleased to be joined today by both chairs of the ERCC. So let me introduce Gareth Allen, Global Head of Investment and Execution in Group Treasury at UBS, now in his second year as chair of the ERCC and also ICMA board member. And Emma Cooper, Head of Fixed Income Repo Trading EMEA Financing at BlackRock and Vice Chair of the ERCC, I think also now in her second year of office. So we have 10 minutes today to touch on some of the key priorities that we're dealing with at the ERCC. But before we do that, let me start by asking you, Gareth. The past 12 to 18 months have obviously been a very unusual period for all of us. So looking back, how did you see the ERCC evolve over that time? And do you think there are any lessons learned for us?
Yeah, I agree, Alex. It's been a very strange time. I think the ERCC and the ICMA, like most other institutions, went remote. I'm sure we'll see a mix going forwards as well of working in flexible locations, depending on the types of roles and regulatory support for flexible working. On the topic of things like ERCC participation and events, I think it's been much easier to organise the larger scale workshops at shorter notice. It's made us more agile, easier to be more inclusive going forwards. I see us using that mixed media to connect with each other in the coming years on topics of interest for ERCC members. But I am looking forward to a time when we can all see each other again in person, right? And finally shake hands when the world is in a much better place.
Definitely, I'd certainly agree. So with that, let's turn to the ERCC priorities. One thing that clearly hasn't changed, regulation continues to be an important issue for us. We've seen the go live of SFTR reporting last year in the EU and the UK, and obviously the EU's CSD regulation continues to keep us very busy. Emma, from your perspective, what have been the big challenges in terms of regulation over the past year, but perhaps also looking ahead?
So yeah, thank you for having me here. Yeah, look, SFTR was a clear focus for all of us as an industry last year. I think we can all agree with the amount of efforts we all put into this regulation, which overall I think has been successfully implemented. The ICMA has done a great job in coordinating these work streams to ensure its success. This, of course, is going to be an ongoing consideration for all workflows in the future. But yeah, looking ahead to the next regulation, CSDR, which is clearly a big focus for the market. It's really challenging to implement without having clear guidelines, and it does really make it hard to define these workflows and predict outcomes. When it comes to mandatory buy-ins, market participants currently don't have robust workflows or the infrastructure around buy-ins, and especially if we're going to handle larger volumes than normal. And saying this though, there's been a lot of really good work and focus from the industry as a whole, just to reduce fails in the market and improve efficiencies ahead of this regulation. The operations committee has certainly done a great job to just try to focus on improving some settlement efficiency within the market.
Yeah, and Gareth, there's clearly a close link here to our extensive work on industry best practices. Can I ask you to say a word about that and what we've been doing in this important area?
Yeah, absolutely, Alex. Look, the secured funding community came together in really great numbers to come up with the SFTR recommendations, which can be downloaded from the ICMA website. We had huge participation through the whole value chain, and the output there is an extremely valuable resource for the industry. Then if we turn to CSDR again, the debates have been intense, the concerns are well known. In parallel, the ERC community have been working hard on the settlement efficiency topics, as Emma said, having recently agreed best practice recommendations for mandatory partialing and shaping in the Euro government bond markets to improve settlement efficiency rates. We've got workshops currently underway on how best to technically implement that across the industry, just recognizing the many challenges we're going to have from the buy to sell side, but very exciting piece of work.
Good. Let's move on to the next big topic, one that has emerged more recently, but which will surely stay with us, the rise of sustainable finance and what this means from a repo perspective. So in April, we achieved quite a milestone with the publication of our first ERCC consultation paper on the topic, and we did receive some very good feedback. So Emma, what's your view? How do you see the role of repo in sustainable finance, and what's next for us from an ERCC perspective?
Yeah, look, from a client perspective, what I do know is the landscape for both green and sustainable investing is evolving, and the demand is growing for our clients and really how they apply an ESG lens to their investment profile. I think it's going to be important to think about, how we define this in repo and collateral markets, and whether it is through best practices, defining the standardization and definitions, to just ongoing monitoring of regulation around this. I think it's going to be really interesting to look at the results of the consultation, and I'm really looking forward to just diving a little bit deeper into this with the committee. But yeah, look, the repo market plays an important role in providing liquidity and financing to help support this growth.
I would echo here as well. This is a really exciting topic for the ERCC to be discussing, just how it might impact secured funding. So ESG is on everyone's minds, and all of the market will be impacted by the changing sentiment from investors and financial institutions, and just to really make a tangible improvement to the world.
Good. Then finally, we should also briefly mention another big cross-cutting theme, the importance of fintech and electronification in the repo market. So Gareth, can I ask you to share your views on the importance of electronification, and also to say a few words perhaps about our ongoing work to develop a common domain model, or CDM, for repo, and why this is important?
Yeah, sure, Alex. I think I've been saying for a long time that the secured funding markets have a long way to go on the technology and the efficiency front. I think there's a natural evolution I see accelerating, especially with all the new and also not so new technologies out there like DLT or cloud. I see the market continuing to become digitized throughout the whole value chain, from the end client to the banks, to the intermediaries, to the central banks even. Low touch trading driven by more quantitative brains on desks across the world. Now the CDM work, that's exciting because it sets a technological standard that can be applied to this whole value chain. It will make future technology implementations easier, simpler, cheaper. And it's just great to see the engagement we've had from members in the work to build on the CDM model and enhance it for secured financing.
Indeed. With that, I'm afraid we'll have to come to the end already. So thank you very much, Emma and Gareth, for sharing your thoughts, and of course to everyone for listening.
Great, thanks for having us.
Thank you.
Good day, everybody. My name is Arthur Carabia. I'm in charge of running ICMA's Asset Management and Investor Council, and I have the pleasure to be joined today by our two vice chair of AMIC, Stefan Jana from AXA Investment Manager and Massimiliano Castelli from UBS Asset Management. Good morning to both of you. For the purpose of this annual conference, we wanted to provide you with a brief overview of what kept us busy in the last 12 months and where we're heading next. Stefan, we're going to start with you and the regulatory developments. What are the main regulatory developments that are currently keeping us busy at AMIC?
Okay, thanks, Arthur, and good day for everyone. As the Asset Management Investors Council, AMIC has mainly two working groups working on two different types of topics. The first one is on sustainable finance. The second one is on risk management as applicable to funds. And during the last 12 months on the sustainability side, the work of the working group on sustainability had a lot of things to do due to the, in particular, the European agenda. We had to cope with the level 2, the implementing measures of the Sustainable Finance Disclosure Regulation, SFDR. We had also to work on the taxonomy. It was the second important work to work on. The third one was even more critical in the very short term, which is MiFID level 2 measures regarding the ESG preferences of clients, to which we will have to propose sustainable investments. And the last topic that we touched upon was on possibly elaborating an EU eco-label for investment funds. This is for sustainability. And regarding the risk management working group, which was the other cornerstone of AMIC practical work on a daily basis. And so basically, since the crisis, we have in particular issued a response to IOSCO, the International Securities Regulatory Body. We had issued such a response demonstrating that regarding fund liquidity management, the European framework, being the pure EU or UK or even Swiss framework, was fully valid to manage crisis situations like the one we had to cope with last year. So, and still ahead, we are going to dig further in IFMD review because, as some of you may know, IFMD is going to be reviewed by the end of this year.
So, Stefan, this essentially means that we're going to do more of the same for the upcoming 12 months, right?
We will have to be more engaged with the Commission on IFMD review during the for the next year. On the sustainability front, we will have also to go even further in connection on that front with regulators. First of all, at EU level, as I said, on data from issuers, the European Commission wants to enhance the disclosure of sustainability data by issuers, what is called the review of NFDR, and now it's CSRD. This is a critical point. And still on sustainability, I think that AMIC will have also to tackle two topics. First of all, the Biden administration is very keen, as you know, on sustainability to be more committed as the US to provide for an US view regarding sustainability. We will have to take into account that new US momentum on sustainability in our work. And still on sustainability, we will have also to take into account a new dimension and a pure international one with the IFRS, which wants to promote and to develop now a sustainability standard board, SSB, to facilitate the convergence of disclosure of data by issuers. As investors within AMIC, we think it's definitely critical as far as possible to get convergent views among regulators at global level, and not only European one, to facilitate our work of investors while we have to invest in issuers from any part of the world. This is on sustainability. As I also mentioned, we will have a FMD, not the least. Digitalization will be a growing topic for AMIC. Digitalization is on the shelf of many regulatory bodies, not the least the EU, but not only, also in the UK, in the US, and even in Asia. On digitalization, we will have to develop our own skills and involvement in that. And last but not least, we must remain agile on any unknown topic yet, from a regulatory perspective, to be able to keep interaction in a flexible manner and reactive manner with any initiative that regulators might launch in the coming months.
Max, those regulatory priorities of AMIC also corresponds to important business and market trends. Can you maybe start commenting on the fintech aspect?
The deployment of digital capability by asset manager is actually quite wide-ranging and include advanced analytics and big data, Internet of Things integration, artificial intelligence, and of course blockchain, and will have multiple applications across the whole industry. In several cases, digitization is actually an efficiency play, which will allow asset manager to do things with less resource and cost. And I believe this is very important for clients as well, because ultimately this will translate into more time-efficient service for client and lower fees. However, I would also like to stress the fact that digitization is also a transformation for the asset management, as new products and strategy will become available. For instance, in the event where we discuss tokenization, one of the main implications of the widespread use of this technology will be to be able to monetize more alternative asset classes and provide them a wider access to smaller investors. Last but not least, I would like to stress as well an important topic that we are also monitoring very closely, which is the launch of the so-called central bank digital currency, which also has the potential to be transformational for the entire financial architecture.
Regarding sustainability, will it continue to be a driving force in the market, Max?
Yes, absolutely. I believe that the sustainability is irreversible trends and to a large extent transformational for the industry. So this means that the key principle of sustainability will remain a very important driver for all asset managers. On the other hand, there is a clear alignment between sustainability and long-term investing. And this is, I think, what makes this very exciting for the majority of the asset manager who work in cooperation and in partnership with institutional and the wholesale clients. So why this is happening? Well, first of all, the sustainability index have shown very clear that they are able to provide the protection during period of market volatility. That's exactly what happened during the sell-off in March 2020. The coronavirus has reinforced the feeling among investors and individuals and politicians that global and coordinated efforts must be made in critical areas to avoid a dramatic risk in the future. And that's exactly the type of challenge that, for instance, climate change poses to us all. We are also seeing central banks pondering whether they needed to contribute more to the greening of the financial system. So definitely, like digitization, sustainability is a major trend that will remain of fundamental importance for the future work of AMIC.
What are the short, medium-term risks to be considered by fund managers?
The market believes at the moment that we are in the middle of a cyclical increase in inflation, and I tend to believe as well in this view. However, we cannot rule out that eventually inflation, rather than remaining a simple transitionary phenomenon, might become a more enduring future of the global economy. Should this be the case, the impact on asset classes, on asset price would be large, with several repercussions across the industry after many years of easy money and soaring asset price. So at AMIC, we will continue monitoring how inflation outlook will develop. The second important follow from the pandemic, of course, has been the massive fiscal expansion experience in order to sustain the global economy in the face of the impact of COVID-19. Eventually, sooner or later, the world will have to deal with this challenge, and this is also likely to become a big political issue. More taxation of high income and wealth appear to be the most logical consequence over the medium-long term, but I believe this will prove very controversial and will have implications for asset managers as well. Last but not least, I would like to mention the geopolitical risk, which I would say concern mainly the so-called deglobalization risk and market fragmentation. In fact, the confrontation between the US and China is a strategic one, which will remain a central feature of the global economy for decades to come. It will also have an important implication for the financial service industry, as we will experience more fragmentation in global market and eventually more barriers to the free movement of capital. For asset managers which operate into a global type of environment, this type of risk will have to be monitored very closely. Finally, I would like to mention very briefly the question of income inequality. This is something that has been going on for very long, but actually has been in some way strengthened by the pandemic. And I believe that the financial markets, in the new world we are living in, where several stakeholders are involved, will also have to take into account of that into the broader concept of sustainability that is starting to spread across all our investment areas.
Thank you all for listening to us, and thank you both Stefan and Max. I hope you enjoy the rest of the annual conference.
I am Rowan Varrell, Deputy Secretary to ICMA's Fintech Advisory Committee. I support ICMA's Fintech and market electronification work. I'm here with Armin Peter, who's been actively engaged in ICMA's Fintech work for some time now. Armin, would you like to introduce yourself?
Of course, Rowan, thank you. Thanks for having me. Armin Peter, UBS. I'm the chair of the ICMA's Fintech Advisory Committee and previously a member of the ICM board until last year, where I was as well the chair of the ICMA board subgroup on technology, and with the idea to give the board advice on the trends in emerging initiatives in this fintech space, and to explore, what is, relevant for and what can potentially impact the market infrastructure, and therefore can drive more or less the topics that would be relevant for ICMA and its members.
Thanks, Armin. So from your different roles you've held in the past couple of years, looking across international capital markets from this helicopter view, which you have a unique perspective of, what do you see as some key opportunities from a fintech perspective?
The pace of technological change continues to accelerate and need to anticipate what its potential means in way of impact on market infrastructure, process and products. I think over the course of the last 12 months throughout the pandemic, this kind of dynamic has accelerated even further. The desire to entirely automate the bond life cycle is ever increasing. We certainly have the desire to see straight-through processes across the entire life cycle going forward. Just thinking about, the use of DLT and tokenization of assets has been already used. The talk about central bank digital currency and those initiatives that we can see globally, it just gives you the idea that, once asset side and cash side are coming together, then certainly this has a massive impact on market practices, market infrastructure, and ask for the need of new standards.
It sounds on one hand, there's substantial opportunities for changing both products and processes, but you alluded to on a couple of points for this forward momentum might be limited by new risks or bring additional pressures on the current market processes. Apart from what you already mentioned, what do you see as the main risks that come with these opportunities, and how would these be addressed?
I think the main risk certainly is fragmentation, that we are diverging liquidity, that markets are not functioning in the same way we actually desire. So in that regards, the risk of fragmentation and at some point in functional markets are probably the two main risks that I can see. All that in my mind, asks for common standards in interoperability of systems. We at ICMA have two key initiatives which are providing a solution and try to mitigate those two risks. In the first place, the common domain model, which is built on the work by ISDA for derivatives and ISDA for security lending. We consider those opportunities as well for repo and the bond market, more broadly speaking, essentially digital standard, aiming to generate industry-wide efficiency gains, enhance the standardization, reducing the need for reconciliation, and the facilitation of interoperability across firms and platforms. And on the second point, the common data dictionary for bond in the issuance process, which for the time being is competitive, fragmented. I think a common data dictionary or a common language would lay the foundation for interoperability, facilitate onboarding and the communication, whilst at the same point would promote competition.
I guess taking a step back from market initiatives for a moment, we're all aware that regulation also plays an important role in the driver of electronification. At the same time, regulators are also facing the same issues of understanding and also managing new fintech developments. How do you see ICMA's role here?
You're absolutely right. The regulator plays an immense role and certainly is the key driver for further development. I think they have done a pretty good job, at least in the last couple of years. They caught up. At the start, they struggled, as you rightly said so. But in the meantime, I think they are on guard. They know what they do. They know what they ask about. And I think in this entire process, it is very, very important to be part of that discussion as an ICMA. We consider ourselves the bridge between the industry and the regulators. The engagement with regulatory community is fundamental to the ICMA's mission. And we have a lot to give in that dialogue to make sure that when regulation wants to be implemented and will be implemented, that it is going to be practical and does not enhance these issues that we talked earlier about in terms of breakdown in market functioning or fragmentation of markets.
On the topic of engagement with the regulatory community, I can say ICMA has been actively involved and contributed to the IOSCO FinTech Network, the Bank of England's Wholesale Data Collection Workstream, and the ECB's AmiPay AmiSeco FinTech Task Force, which has recently published its report on DLT in post-trade processes. We're coming to the end of our update here. Perhaps, Armin, we could wrap up with your forward-looking views. What do you see as the key fintech topics for international debt capital markets over the next 12 to 18 months?
Well, I think the process of standardization and automation is long not over. So will require us to very much continue focusing on this and engage the dialogue with all stakeholders. But then sustainability is of ever increasing importance. The usability of ESG data, whether at a security level or an issuer level, is in my mind a prerequisite to enable fintech applications in sustainable bond markets. Yeah, I see a significant potential, for example, processing large data sets and matching an issuer's data to relevant taxonomies, real-time insight into the performance of green bonds, for example, or simply analyzing the appetite for green bonds. But then there, I think, in the longer term, the transformation of market structures through the tokenization on the product side, and then central bank digital cash that we have seen recently, very much in the press, with a lot of initiatives. Once these things come together, then I do think we will see a material impact on market infrastructure, something which we certainly need to focus on, even when it comes to make sure that we have a smooth transition.
Armin, thank you very much for sharing your thoughts with us, and thank you again for your ongoing support in our fintech work and your ongoing leadership. Thank you very much.
Thanks, Rowan.
Hello, I'm Mushtaq Apasi, Chief Representative for Asia Pacific of ICMA, and I'm delighted to be here today with Ashish Malhotra, Head of Capital Markets for Asia for Standard Chartered, and ICMA's Committee Chair for the Asia Pacific Regional Committee. Ashish, good day, and many thanks for joining us. So first, in the Asia Pacific debt capital markets, what have you seen as the major themes over the last year?
So Mushtaq, starting with last year, of course, come March, April, at the onset of the pandemic, we did see almost sort of stoppage of all issuance activity. I would say more so in Asia than you saw in the West. However, I mean, thanks to the Fed rate cuts, all the sort of monetary policy activity, bond repurchase programs, fiscal initiatives, etc., we did see a sharp recovery in the month of May, with kind of spreads contracted again, interest rates were low, so it brought out issuers actually in a very strong manner. So for the rest of 2020, we saw very healthy issuance volumes to the extent that 2020 was a record year in terms of Asian issuance volume of about 350 billion. So that was about 2% higher than 2019. And what was very interesting is that throughout, the funds flow picture was kind of quite supportive. Now, when you look at 350 billion for 2020, it's not as eye-catching as the US, but for Asia, that is a very healthy number. Now, we of course started 2021 with kind of what I would say from a fixed income perspective, very good market conditions with benign rate environment, extremely tight spreads. So we had a very strong first quarter. We had 100 billion of issuance in Asia, and I'm talking about the G3 cross-border bond market, and which was about 25% higher than what it had been even last year. And then in the kind of second quarter, barring a period where the questions were being asked about what is the interest rate outlook, will inflation be a factor, would Fed start with tapering? But generally, I would say second quarter has also been very supportive. We've seen 65 billion and counting in the second quarter this year, and overall the run rate is about 20% higher than what it was last year. Now, when you look at where the supply has come from, of course, geographically, this year particularly, you've seen Korea very strong, supply. South Asia generally very strong supply. Of course, in South Asia, the last few months it's been a bit different because of the kind of second wave in India, and of course China. China has been rock solid, and the supply patterns have been higher than last year. What has been interesting within that is that sovereigns and SOEs have been very active. So, to give you some example, Malaysia chose to come back to the bond market after around 5 years this year, and then we've seen new sovereigns as well. I mean, Maldives is one example. And then when I think kind of away from sovereigns into the corporates, I think two sectors that stand out for me are TMT. I mean, a fair bit of issuance and some very large, chunky deals from kind of tech sector there. And of course, oil and gas issuers have done some large deals as well. So, overall, 2021 so far year to date has been pretty impressive as well.
So one quick follow-up to that is, how have you seen actual deal operations, the way deals are being done, the practices change in Asia over the pandemic, and has this been similar to what you've seen globally?
Yeah, but generally speaking, yes. And but one thing we have to keep in mind is when we think about deal practices, we are essentially talking about how has work from home worked. And I would say that if you look at the last call of 6 to 12 months, the work from home has varied from a time to time, and it has also varied from country to country. So to give you an example, China is pretty much back to BAU. I mean, there are client meetings happening in China. There is domestic travel happening in China. People are going back into offices, etc.
Conferences.
And when I look at Hong Kong, when I look at Hong Kong and Singapore also, I mean, there have been more instances of people coming back into office. Some of that have been team A, team B. But, in Hong Kong, as you know, that, client meeting activity, lunches, etc., have happened. But when I look at away from kind of Singapore into rest of South and Southeast Asia, it has been largely work from home. But the good thing is, it has worked very smoothly. I talked about how issuance volumes are running at 20% plus versus last year. So that is kind of good evidence that despite working from home and kind of working from home changing from time to time, if there's like a second wave or something, deal execution activity has gone on kind of quite smoothly. In fact, if I can say, we have seen a lot of first-time issuers in the market. We have seen a lot of issuers that are not regular issuers, but have chosen on, due to low rates and interesting spreads to come back into the market. And in normal days, those issuers would have done a week and a bit of a roadshow involving travel from one part of the world to another, and then priced a deal. The same issuers have actually been able to price deals with, call it 1 or 2 days of virtual marketing. So in a way, it has kind of compressed the market risk period, if you will. And another example, again, closer to home for you, is last year when there was a Typhoon 8. Normally in Typhoon 8, activity stopped.
Everyone went to work at
but
home.
They were still being priced. So everyone was working from home, so people were still pricing deals and doing deals that day. So it's been interesting. But of course, personal lives and in terms of mobility, etc., they have had an impact. And I'm sure all the market participants, etc., are looking at various aspects of that and determining that as we kind of reopen from here, what would workplace and execution activity look like.
But it's a very interesting point you make about the ways that deals can be done in some ways more efficiently, especially debut issuers, and actually affecting and decreasing market risk. Very interesting point. Okay, one more question for you. So just taking a broader view, in your capacity, you're wearing 2 hats here, both as ICMA regional chair and head of regional business. What do you see as the main ways that ICMA can improve practices and develop markets in the region over the next year? What should our priorities be?
First and foremost is the regulatory focus on institutional primary debt market. Hong Kong, for example, but elsewhere as well. So the work that ICMA is doing, which in the short term, of course, has to is catered towards making sure that any reform, any changes, are effective. But at the same time, in the long term, kind of making sure that we are promoting standard documentation, market practices that not only comply with regulation, but lead to really better deal execution and activity, and as well as a marketplace that is healthier and happier. So that's one. Second is again, sustainability, but that's a space where ICMA has been a vanguard of all the guidance, etc., in terms of sustainable finance. Now, what has changed is that increasingly, regulators are having a say, and they are coming out with their view in different aspects of sustainable finance. Now, be it taxonomy, be it disclosure, or a product level regulation, and this space is kind of evolving very fast. So ICMA's role in making sure that the market participants and its members, etc., kind of navigate through this complexity. And when you put into it also with the sort of net zero commitments of various economies in Asia and what that means for bond market. So ICMA has an important role in terms of so that all market participants are able to kind of do businesses, and in the end, kind of trying to promote international standard market practices in that space. So that's the second area that comes to mind. And the third one, and this is something again you and I have spoken about, is fintech. Now, of course, there are fintechs all over the world, but some of the sort of interesting innovations, if you will, with respect to the fixed income business are there are fintechs in Asia who are working in that space. Now, whether that is a pilot digital bond scheme or it is a primary market platform, or it is a platform that allows for greater retail participation into the bond business, or is applying kind of DLT technology into the bond settlement space. A lot of that work is happening in Asia. Now, when you combine that with a recent development where even in the space of sustainability, some fintechs are looking at that, and the two areas are converging. And a very good example of that is the Climate Impact X that was recently in the news. I think ICMA has an important role, to make sure that we are monitoring and staying on top of all of these developments, and eventually kind of getting our head around and helping the industry get their head around as to what it means for market practices and the DCM and the capital markets business in the future.
Okay. Well, that's all the time we have. But Ashish, thank you so much for sharing your perspectives with us. It's always a pleasure to speak with you, and I look forward to continuing to work with you.
Likewise. Thank you very much, Mushtaq, and have a great evening.
You too. Take care. Thank you.
Thank you very much to the chairs of our ICMA committees for outlining the main developments in their areas over the past year. Thank you for the time and energy you devote to ICMA all year long. I'd also like to take this opportunity to thank the ICMA staff who do a terrific job coordinating these work streams. Thank you very much for all your efforts. It is my pleasure now to introduce our next speaker, Andrew Cross, Chief Financial Officer of the Asian Infrastructure Investment Bank.
Good morning from Beijing to all attendees of the ICMA Annual Conference 2021. My thanks to my friend Martin for inviting AIIB to be a keynote speaker of the conference. While the pandemic may be derailing our routines, the ICMA Annual Conference continues to connect yearly and from a wider perspective, experts and market reviews of the main trends and developments in the international capital market. ICMA does this very well while looking at the impacts on the global economy, thus allowing us time to reflect on the market over the coming years. I am particularly delighted to discuss post-COVID-19 sustainable development through the capital markets. The pandemic has rippled through every corner of our communities at a virulent speed. Over the past 2 years, we have been fighting this common enemy. It has taken a heavy toll on human lives. It has caused an economic emergency. In practical financial terms, we must make more strenuous policy and strategy efforts in both the public and private sectors to contain the impacts of the virus. No one has been left unscathed from this pandemic. We are, however, hopeful that in the immediate future, COVID-19 will be brought under control, allowing us all time to find breathing space to consider and plan our actions post the pandemic. While the good news of vaccines in recent months ensures us against the current business cycle of locking down and reopening, we are seeing market resilience in preparation for the post-COVID-19 days. As the Chief Financial Officer of Asian Infrastructure Investment Bank, I have the privilege and the challenge during these critical times to provide strategic and technical leadership in financial and treasury management. The challenge also requires me to ensure AIIB's sustainable financial strength and steady growth in financial resources. Keeping abreast of capital market developments and opportunities is always at the top of my priority list. I will share with you first my views towards the sustainability of the macroeconomy and the bearing on the general investment atmosphere. I will also touch on how the Asian Infrastructure Investment Bank plans to address the challenges ahead. Before COVID-19, over the past decade, we were already experiencing the constant evolution of the global value chains due to global technological paradigm shifts. In the economic sense, we see the continued technological advancements sustained along the production frontiers, moving the business focus from goods and services to information, and from data mining to big data. The industrial sectors are becoming more and more fragmented through tailor-making, coupled with wider automation and use of artificial intelligence in the production or services process in the name of efficiency. With the COVID-19 pandemic shock, this has amplified imbalances in the demand and supply across many sectors. In response, such unprecedented shock is being met by a record level of financial and monetary policy responses. Added to it are more fiscal stimulus in the form of subsidies or tax cuts. Such freeing up of capital by central banks and public financial authorities has led to significant public debt across many countries. As a result, there remain uncertainties to the underlying recovery throughout many sectors of the economy. While the US fiscal and monetary policy continues to play a very significant role in this critical time via global trade and financial links, China has also displayed prompt economic resilience through effectively containing the virus, sustaining natural economic growth with policy easing, and consolidating its role as one of the locomotives of the global economy. These developments have helped mitigate the imbalances of the aggregate demand and supply. A broader-based cyclical rally in financial assets is expected in the coming future. Equities could benefit from such a financing atmosphere. Against this backdrop, though, returns from fixed income are likely to remain constrained with low levels of yield and credit spread. Returns from fixed income strategies appear even more challenging. That said, it's also worth noting that while US interest rates have fallen to historic lows in early 2020, a rise in long-term interest rates has been observed since the beginning of this year. In preparing for the post-COVID-19 days, another emergency, equally dangerous for humanity and life as we know it, has been steadily bearing down upon us for quite a long time. We must also pay attention to this threat. The world faces a climate change emergency that is getting more serious with each passing day. While we are faced with colossal global challenges like COVID-19 and the climate emergency, it is crucial for the international community to work together and devise sustainable solutions. Multilateral cooperation has never been as important as it is today. We must prioritize the buildup of health infrastructure with equitable distribution of vaccines so the virus can be stopped and to also ensure the developing world does not fall further behind. Founded in late 2015 and opening in 2016, the Asian Infrastructure Investment Bank is a multilateral development bank built to foster sustainable social and economic development in Asia by investing in infrastructure and other productive sectors. Starting from 57 founding members to currently 103 members, and backed up by our strong multilateral governance structure and financially and environmentally sound investments, AIIB has positioned itself as a key development partner for countries across Asia and beyond. The past 18 months or so have disrupted everyone's idea of what tomorrow will look like. We are in the midst of great change, but from this upheaval, glimmers of hope can be seen. I must emphasize that we fully believe investing in sustainable infrastructure for a post-pandemic economic recovery is one of the most effective ways to revitalize the economy after a crisis. It comes down to the triple benefits of infrastructure investment that include short-term income, long-term growth, and vitally, environmental sustainability. Multilateral institutions like AIIB are an important part of this equation, not just by catalyzing financing, but also by ensuring high standards in procurement, as well as environmental and social safeguards. These policies are an integral part of our lean, clean, and green values and represent AIIB's commitment to continually learn and evolve our lending operations to adopt better ways of doing things. On the climate change front, a shift in political appetite to transition towards a greener, more sustainable future was signalled in the recent Leaders' Summit on Climate. As many have pointed out, this will be a difficult endeavour that will require the world's leaders to transform many aspects of their domestic economies. Success will be predicated on all sectors and levels of government responding collectively to certain facts that we're all aware of when it comes to the climate. First is that we are in a climate emergency. Second is that we must create coherent policies that would be reflected on infrastructure development and from the viewpoint of financial resource sourcing and allocation. At AIIB, we have made it clear in our corporate strategy that we will do our part with a commitment to have 50% of our approved portfolio dedicated to climate finance by 2025. In the capital markets, we are pioneering, amongst other things, the AIB Amundi Climate Change Investment Framework, which aims to provide investors with a benchmark tool for holistically assessing climate change risk and opportunity for investment. The world has been changing. I think we all know this. Innovation as a core objective of AIIB will continue to drive the complexities in the bank's operations amid these changes. As CFO of AIIB, I will continue deepening the development of our financial information systems in tackling these complexities, in consolidating our sustainability focus on financing and investing in infrastructure that is climate resilient and technologically enabled, while promoting connectivity and regional cooperation. ICMA has a clear commitment to building trust in the financial markets by promoting internationally accepted best practice through the development of standard documentation aimed at maintaining and enhancing the framework of cross-border issuance, trading, and investment in debt securities. ICMA has contributed significantly to the promotion of resilient, well-functioning, global, coherent cross-border debt securities markets, which are essential to funding sustainable economic growth and development. In this regard, Asian Infrastructure Investment Bank and ICMA both have a critical role in driving a brighter future for the capital markets in the post-COVID-19 world. ICMA and AIIB are both committed to global economic development through the financial services sector. We are both ensuring that every industry and branch of the financial sector, every stakeholder and player contributing to it, gets what it needs to flourish deep into these post-COVID-19 days. Let me express my thanks to the International Capital Markets Association for giving Asian Infrastructure Investment Bank this welcome opportunity to speak to you all today. Ladies and gentlemen, I wish you all the best of health, best of business, and best of investment in 2021.
Thank you very much, Andrew, for sharing your views on climate finance and the challenges of maintaining a sustainable recovery. We now move to our panel of industry leaders who will be giving us their views on the outlook for the capital markets.
I think let's wait for Mandy to come back, but in the meantime, let's talk about the panel, if we may, and ask you to introduce yourself. We have a very distinguished panel here, as Mandy mentioned, both the buy and sell side and a major market infrastructure. I think we will start with ladies first, and Beatrice, perhaps you would introduce yourself.
Hi, hello, my name is Beatrice Martin, and I am the UK Chief Exec for UBS for the group here, and I'm also the group treasurer for UBS. Thank you.
Thanks, Beatrice. Julia, you've recently moved. Perhaps you'll talk about your new role and experience.
Yeah, good afternoon and good morning, everybody. Julia Hoggett. I am the new Chief Executive of London Stock Exchange plc and formerly the Director of Market Oversight at the Financial Conduct Authority, but I am now 9 weeks into my new role.
Thank you very much, Julia. Welcome. Jean-Luc, you're a board member of ICMA. We know each other well. Perhaps you can talk about your role, please.
Sorry, I'm Jean-Luc Lamarck. I work for Crédit Agricole CIB, and I'm responsible globally for debt syndicates, for credit trading and credit sales.
Thank you very much, Jean-Luc. And Ingo, you're also one of our board members. Welcome. Perhaps you'll just talk about your background very quickly, please.
Thank you very much. So it's a big honor to be a board member of ICMA. My name is Ingo Meinert. I'm from the buy side. I'm the Chief Investment Officer responsible for the multi-asset function within the region Europe.
Okay, so we've covered the buy side, we've got sell side, we've got market infrastructure. What are we missing? We're missing the issuer community. Tim, you're the treasurer of KfW. Perhaps you want to introduce yourself. That's one of the biggest issuers in the capital markets.
Yeah, thank you very much, Martin, and thanks for the invitation or for the ICMA. My name, as Martin said, is Tim Ambrose. I'm the treasurer of KfW. We are one of the largest issuer, but we're also an investor. So we have both roles, which we are targeting.
Very good. Now, I know that if Mandy were here and she were able to connect properly, then we would be starting to talk a little bit about the first set of questions. But just by way of background, I mean, we're all aware that of the impact of the pandemic. We've seen the measures taken by governments, taken by central banks globally to stabilize markets, to inject liquidity. It's still happening. We're hearing a lot about the inflation perspectives as we see the economies recover. Almost every day there is a pronouncement from one or other central banker as to whether this is temporary or whether it's systemic. And but they certainly took a lot of activity to do that. And following that, it seems to most of us, I think, that the financial markets have fared relatively well. And we heard a lot about that in the discussions from the chairs of our various committees. But we are starting to see, really green shoots of growth returning. And some of those green shoots are longer than others. Some of them get burnt by a bit of frost from time to time. But on the whole, we are seeing the garden starting to grow again. So I think that's one of the backgrounds here. But that doesn't mean that we're out of the woods, to use a mixed metaphor. We're certainly not. And there are going to be a lot of challenges ahead for us as we emerge from the pandemic. And I just want to pick up one or two of the points on that. And I'd like to turn to you first, if I may, Jean-Luc. And perhaps you can talk about how you think the markets have managed the pandemic and any particular changes that you've seen. You interact every day with clients, you interact with markets every day, you interact with your colleagues, so you see your own workplace. Any observations that you would like to make?
Of course, thanks very much for giving me the opportunity to speak about all these very hot topic, if I may use this term. Certainly, the volatility, if we turn back the clock, the volatility has been extreme. Obviously, in January 2020, everybody knew that COVID was coming, but it was in Asia, and I don't think anybody realized that it was going to be very soon across the planet and changing our life, day-to-day life, massively, as much than anything else in centuries. So if you're coming back to March 2020, we had a massive volatility on the market, obviously on the credit market. The crossover moved from the low 200 in January to 700, which is a massive move, which we haven't seen even during the Lehman crisis, or quite comparable. And certainly the equity market crashed because the Friday, 13th of March, can be called a Black Friday because it was the worst day of trading in equity since 1987. So from this situation, I think what has been really impressive is that we've seen an enormous support of a various range of public sector entities. I think I would like to summarize that in what has been called in 2008 too little, too late, by a lot of journalists and market participants, can be say that in March 2020, the reaction from Bank Central first and other government was whatever it takes. whatever is needed will be done. And then it was totally impressive because obviously the central banks flooded liquidity more than ever and immediately with absolutely no delay. We've seen the government immediately relaxing the constraint in terms of budget. So obviously a lot of money has been put on the table in that respect as well, including some loans which were guaranteed by the government for medium-sized companies, which again has been a very quick reaction. And obviously, what has been really impressive, certainly in Europe, was the common reaction of the European Union. Because in a very short period of time, we had the European Union putting something which a lot of people were thinking about for decades and never happened before, is that a common issuer. EU came with a massive amounts of issuance, first with the program SURE, which they managed to raise almost 100 billion in a very short period of time, pretty much a year or even less than a year. Also, we now have NGU, which has been put in place and has started to issue, as we all know recently, with a 20 billion gigantic 10-year benchmark. And the program is actually 750 billion total, which again is a massive amount of money to be put in the economy. So this recovery is obviously due also to the quick reaction of all these public entities that I did mention. And I think last but not least, it's very important if you talk about liquidity, about the TLTRO. TLTRO has been instrumental in bringing liquidity into the system via the banks, which obviously are the lenders to the economy. And the TLTRO in June has reached a level which was absolutely amazing of 1.3 trillion, which has never been seen obviously before, and in fantastic conditions for banks. So what did it bring? I think it brought a lot of relief to the market at a speed which has never been seen before. If you remember 2008, in September 2008, Lehman collapsed, and then we saw the market close for several weeks before we see a very slow and small amount of new issues coming back. And here you have the intervention of the central banks in March 2020, with the peak of the crossover at 700, with the lowest level on equity, as I said. And immediately after, you see in April a record month in terms of issuance, which has never been seen before. And so the corporates were the first one to react. They came to the market very quickly. And because the central banks and other public entities have done a fantastic job restoring confidence into the markets, investors immediately seen the level of spread as opportunities. They were not scared. So they did participate immediately from day one to transactions which reach records oversubscription and which reach records level of volume as well. So that's very important, that the issuer reaction. So they were not scared to come, they were not scared to be pioneered into the market again, contrary to post-Lehman. And that's really a massive change compared to that period of time.
Thank you.
And obviously, as I said, on the issuer side, financial institutions were probably obviously less present or less active into the market, but it was due to this TLTRO, which brought a lot of liquidity. So you don't need to bring, I know Julia knows the covered bond market better than anybody on that panel, but certainly there was no need to bring any covered bond into the market. There was no need to bring any senior preferred into the market. And because ECB had relaxed a little bit the capital constraints for bank, we haven't seen a lot of, obviously no additional tier one, limited amount of senior non-preferred and tier two at the time. So it was mainly driven by corporates, and obviously the SSA world has been functioning almost as usual, with obviously an increase of volume for the sovereign. As I said, the investor reaction was absolutely remarkable. All of them were willing to participate. All of them were willing, and certainly Ingo had benefited from that in his performance last year. Were coming early enough in the trades and were volunteers to play. So all in all, it brought actually a the market in a quasi-normal market functioning conditions in about a few weeks, which is remarkable. But I think I wouldn't be complete in the comment if I wouldn't obviously mention the change for the individuals and the change for the firms. We move from, in a few days, and in some cases in a few hours, from all in the office to all work from home, which is incredible. And to be honest, being in that market for more than 3 decades now, I can tell you that I'm used to go to the office every day, and I was part of them, of the people allowed to stay to go to the office, but a lot of my colleagues were not. And so a lot of people were working from home, and it did work very well. To my surprise, and to many people's surprise, we did function extremely well with working from home. And so in that respect, I think we will never see again the same way of working than we've seen before COVID. Now, I think we will see more flexibility to the benefit of everybody. And we have less complex to have people sitting in Paris office or sitting in London office, although there is some benefit, obviously, to be together and to go for beers after work. That's something which is important. And I want to mention that as a Londoner, but the world has changed and will not come back to what it was previously. And then I like to finish on a positive tone as usual when I try to. Certainly there was some benefit of this COVID, is that we all travel far less than before, and it was very beneficial for the climate change. That's all I have to say. I will be very happy to take any questions at the end.
Thank you very much indeed. And a couple of points. One, you're looking very well for 3 decades in the capital markets, that's for sure. And secondly,
I take it.
You mentioned the NGEU and the SURE program. I mean, those have been game changers also for the sustainability market. We might come on to that later. And you talked about a little bit the normalcy returning. And I think that's a good segue into the next topic that we want to discuss. And I'd like here to turn, if I may, to you, Julia, and to just ask you, what do you think is going to be the new normal? Everybody's talking about the new normal. We're all grappling with how do we get people back to the office, or whether we get people back to the office. How do you see this in the future? And do you think the markets are actually appropriately positioned to accommodate what this new normal might look like?
Yeah, the good news is yes, I think they are. So I'll start with the big answers to the question. The second point is I think there are multiple layers of what normal is. So if we start with what the markets are there to do, and I always think about markets not in terms of basis points or big cover ratios, but about the fundamental role they play in economies and what purpose the funding is put to. And we're already seeing the effect of that new normal in the transition of what's happening, both in terms of the sheer volume of issuance that we've seen from governments, reflecting fundamentally the different role the governments are now playing in the financing of the economy and of the recovery, but also the recognition that there are different institutions that are now having, Mandy's back, now having different kind of real take-up in terms of the appetite for them as institutions in the market. So the transition we've seen on the LSE already tells me that new normal is already here in some ways. Over 50% of all the new financing that's been raised on the LSE this year is in technology or technology-enabled companies. The second largest is in consumer, it's about 30%. And only just below that is stuff that is supporting the green economy. Now, that illustrates the transition in terms of the scale of where money is going and where the growth is coming from in the economy that is already happening. But it also illustrates that we've had two different worlds. I was at the FCA as we were transitioning to everybody working from home, and very actively involved in all the global conversations that took place to keep the markets open and orderly. And the reality was that, exactly as Jean-Luc outlined, the volume of activity that continued, despite the volatility that was happening, the transition that everybody took to moving to working from home was remarkable. And the financial markets proved their resilience in those circumstances. And yet there are other parts of the global economies that have not recovered and not been able to operate in the same world. So there are different lenses in different sectors of the economy. And in terms of how we think about the new normal, that is one of the things we will have to factor in. How our economies shape and structure and the main drivers of it, the drivers of growth, are transitioning. And I think that is something that we'll have to recognize. In terms of ways of working, I don't think you put a hybrid genie back in the box. I think that is going to be something that is maintained. And Jean-Luc made a good point. We've now realised that things are doable in a way that we had not before. I observed from afar numerous universities that had spent 5 years discussing taking teaching online and did it in 5 days. And once you've done it and you realise it works, then that changes it. I think roadshows have changed forever. As someone who used to spend 125 days a year on the road marketing bonds, I'm afraid I'm not objecting to that. I'm probably quite a buyer of that change. And I think that is something that will change. So I think we are in a different place. The final thing that I think is different is I hope the contract has shifted in terms of an understanding of how the system works and how everybody contributes to it. If you look at the level of investment that has been invested by G20 countries, the fiscal packages have exceeded $10 trillion. Now that's, I think, 3 times more than the 2008 financial crisis and 30 times larger than the Marshall Plan. So the nature of the recognition of the role of the state and how we are going to work through this transition and how we harness this transition to a green transition as well as simply one that drives economic growth, I think is a new shift. I don't think we need to wait for the new normal. I think it's already happening and it's already there in some ways.
Thanks, very thoughtful comments. And Tim, you're very close to the way the markets operate. I mean, it's part of the day-to-day focus of KfW. What are your views? What are you seeing for the new normal from your perspective?
Yeah, there's a lot what I could echo what Julia said, but maybe to give you a little overview what has changed in KfW as a promotional bank. Before Corona, we had around 1,000 mobile workstations. We have now 5,500. If you compare this to all employees, what we have, these are 6,200. So you see a massive upscaling, and there's a lot what Julia or what Jean-Luc also said. On this other side, I think a lot of processes have changed. I take, for example, education, in-house training. There's now at KfW 90% in virtual format. Will be maybe in the future more hybrid. I would say there's a good chance for it. But I definitely think that the virtual format will also stay. On the other side, recruitment, I think recruitment processes changed a lot. Of course, we also in KfW, in the KfW group, didn't stop recruitment. So recruitment is totally changed now that you have the first contact now, as example, via video calls. And then if the environment allows it, then you have probably a personal meeting. But this is something we also will keep for the future. And I think the most important change is that we communicated to the staff a few weeks ago that we target a home office quota of 40%. That means, in a nutshell, 2 days a week working from at home. There's a major milestone for KfW. The home office quota before pandemic was, I would say, below 2%. So you can see a massive development in this topic. Yeah. But this goes also, that's very fair to say, with a concept of desk sharing. Yeah. So this is something what we want to roll out in the next 2 years. What also Jean-Luc said, we're focusing at the moment, of course, the onboarding process. Yeah? And there's, of course, a lot of social aspects also to think about. There's a lot of new people who are hired. Also, for example, in my area, where probably they have never met the last 1.5 years together, never were socializing this topic. I think it's a very important topic to bring those people together, to know each other, to get the grip, I would say. And not forget, we also have to go back to regulation. Yeah? Also, if I look at my area and with regards to the trading activities, if we go all back to the office, of course, there will be no trades anymore for the home office, as the German regulator is very clear with this, to have this back in the trading areas. And maybe my last comment, of course, we all hope for the best, but we also have to prepare for the worst. So we have to be watchful. If I look the last figures, what I see with corona variants, if I see the different, I would say, dynamic of vaccinations worldwide, so I wonder if this is all really 100% locked in a good way, or I would be really more on the sensible side to say, let's be also prepared for a second round. Yeah.
That's very helpful. Thanks a lot, Tim. I'd like to slightly change tack now and look at the macro picture a little bit, and I want to turn to you, Ingo. You know, we mentioned earlier on that, you know, there are renewed signs of inflation, and there's a lot of discussion as to how persistent that's going to be. Be very interested from an investor perspective to get your view on that, and where you see that inflation, whether you see that developing in a systemic way. And also, I think another topic I'd like to pick up with you, if I may, and we also a little bit discussed it earlier, and I mentioned it in my speech. Obviously, we're having to deal with various different markets in different ways, particularly after the end of the post-Brexit transition period. I'd be interested to discuss with you whether you see any fragmentation risks going forward.
Yes, happy to do so. I would like to start with your first question regarding inflation expectations. I think so far markets, or the narrative in the markets, is that the consensus view is regarding it as transitory. We are not so certain about that, which means we really see serious inflation risks. And I would like to give you at least 4 structural reasons and maybe 1 more cyclical one. The 4 structural reasons are demographics, central bank reaction function, climate change, and reshoring regarding the supply chains. The cyclical one is 2 sentences at the end, is monetary growth. I think demographics, that's maybe still underestimated, that we have a big change in the demographics now, aging. And there is, in the meantime, I think this famous book of Bradhan and Goodhart about the demographic change which we are facing, the big or the great reversal. And that means that the labor factor over the long run structurally will becoming more expensive. The second one is the central bank reaction function, and I put it quite pragmatic. Most of the central banks today are fighting for inflation, not against inflation. And that means something, at least over the long run. The third point, climate change, and I think we have heard that before, no doubt about it. We are facing immense climate risks, short-term, mid-term, long-term. So we have to tackle that. We have to transform our economy globally into that, but that will come at a cost. And at least for the next 3 to 5 years, that would also mean that structurally, inflation will go up. How big, how far, how long, we will see. But at least I would say the trend for some kind of higher inflation out of that transformation is there. And last but not least, and I think that's maybe a little bit underestimated so far, reshoring. One of the effects out of the pandemic situation is that each and everybody, economy, states, but also companies are doing a due diligence about their supply chains. And that means that maybe the primary target is not going outside or outsource because of lower prices. There is even now a second criteria, which means control. And for that, I think this means all other things are equal, also higher prices. So 4 structural trends which are changing relative to the last 30 years, which are going towards a higher inflation. And the cyclical component, and I'm quite sure there are even more arguments, maybe, but the cyclical component is money matters. I think in the meantime, and that's the big difference to the last decade, it is not only central bank monetary supply, the broader monetary aggregates, and I'm speaking mainly about M1, M2, and especially M3. The broader monetary aggregates are in the meantime extremely going up. That's a big difference if you look back over the last 10 or 15 years. M3 now in Euroland is plus 10% year over year. That was never so high since 2006, 2007. So from that point of view, a big difference relative to the ex-post area after the great financial crisis in 2008, 2009. And from that point of view, we think there is a real inflation risk now. And from that point of view, we are maybe a little bit more nervous about that discussion, inflation expectations at the consensus in the market, which is still going towards transitory. Your second question, fragmentation. And yes, I think we saw some quite positive trends, and some of the colleagues have mentioned that before. But please, we should have in mind, we have so far, it sounds maybe a little bit strange, sorry for that, but we have a honeymoon scenario in the markets. Each and every segment is at all-time high prices. Prices on the bond markets, all-time high, all over the board. Equity markets, all over the board, all-time high. So what does that mean if we still have a situation which is more fragmented than before 2008? And I still think market fragmentation, which happened extremely in 2010 to 2013-14. Since then, we saw some positive trends, but still the markets are more fragmented, and they are more fragmented than originally hoped for and before. And that means something, because that the situation can improve much better by markets. Yes, there could be always higher all-time highs. But at one point in time, there will be a correction, there will be a consolidation, which is normally also healthy. I fear a little bit that the market fragmentation is relative to honeymoon and Goldilocks is a little bit too strong, and we have to do something against that. And I think maybe that's one of the questions later, and I'm happy to say my personal views or the comments is, I still think this is why the project of Capital Markets Union, very generic, I know, very generic. We have to bring it down from heaven to earth into the machine room. But this is why that project is so important, because it is partly tackling that issue.
Very good. Thank you very much. That's a very clear tour d'horizon of your views, and much, much appreciated. Bear, we're not going to come to you quite yet, but we haven't forgotten you. I don't want you to worry. But I just want to get through one other question and turn to Julia for this. Because Julia, in your previous life, well, you've done lots of things in your previous life, but one of the most recent role, prior to this one, was with the FCA. So you're all over regulation. And I think we spend a lot of time at ICMA thinking about regulation. So I think it would be very interesting to hear from you whether you think, now that you're not a regulator, you might be able to say whether the regulatory response has been appropriate, and what further regulatory changes do you anticipate, or major ones anyway?
Good question. I'm not going to put words into the mouth of the regulator now that I'm regulated, as I hope you would appreciate. One thing I would say is a general observation, and I was, as I said, very much in the mix of what we were doing on the securities market side, on the global coordination side, to keep the markets open. There was something about the fierce urgency of now that COVID generated, that generated a level of international coordination and collaboration and focus on all of our parts, whether that was central banks, whether that was government, whether that was securities regulators, whether that was banks, whether that was issuers, etc., to create the market effect that Jean-Luc described. One of the things that I think is really interesting is, where do we go now, where that fierce urgency of now is very dispersed. And it raises interesting questions about individual country responses. It raises individual questions about the risk of fragmentation, and fragmentation fundamentally is not useful for markets, because markets benefit from bringing pools of liquidity together, and the ease of the global operation of capital. And that will always be something that I think we all feel that we benefit from. But the key issue for me going forwards in terms of regulatory response is there will now be a much more fragmented set of agendas, which don't have that fierce urgency of now attached to them in quite the same way. So it will lead to the need for global prioritization. Obviously, with COP26 coming up, I think the prioritization of exactly what the regulatory response is and how coordinated it is as it relates to climate change is one of the critical things that when we look back at 2021, we'll either decide whether it's been a good year or a bad year according to that mark. And we can't leave the transition and Brexit out of that as well. And so I think the key issue is making sure that those ways of working, those forms of collaboration, those clear focus on the problems and therefore the solution set are ones that I think we try and harness and keep, and we don't lose, because I think you can already see that there are multiple different agendas, multiple different priorities that are coming out, and that will be the challenge.
Yeah, I think I agree with you. Thank you very much. What I'd like to do now is move on to just a short comment, shall we say, on fintech, and I want to turn to you here, Bayer, if I may. And we've all heard and we've seen day to day, we're able to do this in the digital world. We've seen how the digital world and digital finance has been accelerated by the pandemic. We are starting to see new competitors entering the value chain. We're starting to see existing incumbents and major global firms creating partnerships that they perhaps wouldn't have thought about 4 or 5 years ago. And there are many other changes that we can anticipate to market structures going forward. We all hear all the time about DLT, blockchain. We're looking at crypto assets. We're looking at the way the regulators are trying to catch up with the movements in the market. But I'd be very, very interested to hear from you, Bayer, in your role, your thoughts on these developments, please.
Thank you, Martin. Thank you very much. Look, I mean, I think there's no doubt that the financial sector has pioneered the adoption of electronic markets. We saw that with exchanges, clearing houses, multilateral trading facilities, which, frankly, today that is the backbone of today's globally integrated financial markets. I think the financial markets activity throughout, before COVID and even more probably through COVID, has become more disruptable as technology has been advancing and has led to new players being able to enter the market. And I think as we stand right now, we have, I think, financial services represent a relatively small part of the big tech firms' overall activities, although we have seen some places like in Asia, for example, how this can change very rapidly due to the unique features that we see in some of their business models, and particularly if you think about their ability to harvest and analyze data on consumer preference, for example, which have grown systematically as something really, really important in the retail sector. The pandemic has accelerated some of the aspects here, and the regulation, as you said, and I look to Julie as well, because at the time we did have a lot of conversations, and we continue to have with the FCA about this, is very, very important to accompany the speed of change. And for example, some firms need to be cognizant of the impact of things like artificial intelligence and what is the impact of those into client outcomes. And we have seen some regulators, for example, the US regulators, who have expressed some concerns about future trading on blockchain-based decentralized platforms. So clearly, I think, the regulatory framework is yet to be developed. And, I think the idea here is to achieve one framework that will be technology neutral, or from a technology neutral approach, focus on the risks that these activities will present, and obviously that we haven't seen before, that is designed to deliver fair client outcomes, but also ensuring a even or a level playing field and avoid any arbitrage, which I feel banks have felt over the last years, as a more the heavy receivers of that part of regulation, while others were able to enter that market. So I think the principle should be same risks, same rules, right? So the same rules that you apply to banks to, do certain activities, you should, if the risk is the same, apply to those who, in principle, are non-regulated bodies or firms like us. We believe that a lot of the innovation in the financial industry will be driven by fintech, as you said, Martin, and obviously we have been collaborating, as many other banks, with many fintechs, accelerating some of the projects we have, or even thinking about how to modernize our own infrastructure. And I think they add quite a lot of value in terms of, the way they modularize some of the technical, the technical components that we would like to access to public cloud, microservices, artificial intelligence, and so on. And I think the biggest hurdle for somebody like us in the banking sector is really how to do that front to back. I think the complexities of the businesses we run have meant that we don't really find a lot of full solutions, and we need to live with partials in a way. But we have partnered with other firms like Finality, for example, the consortium, which I'm sure everybody knows, which is working on implementing a asset-based digital settlement instrument, the utility settlement coin, and on distributed ledger technology for the use of institutional and financial markets. And if you think about that, I think unlike cash held at commercial banks, deposits, the USC, so the utility settlement coin, will be fully backed by cash assets held at central banks. And as such, I think could have a wide-ranging benefits from risk reduction and improved processes, and of course the whole cost side. But particularly, I think around clearing and settlements and minimizing really the complexity and the time that we take to settle and clear trades. I think we've heard the Bank of England talking about digital issuance. We've seen them very engaged on digital currencies, or central bank digital currencies, and I do believe that is going to be one of the biggest changes that is yet to come in our industry. And of course, ICMA has been working with ISDA to extend the development of the common domain model, which creates a common building blocks, a machine readable format to enhance standardization and basically facilitate interoperability across the firms and the market structures. I think it's really important that we see a push from the market infrastructure to move into that more innovative infrastructure, because and we've seen SIX, we've seen the Australian exchange as well. But I think, it is important that, exchanges and clearing houses move in that direction, because without that, it's going to be really difficult to achieve, the outcomes.
Yeah, I think you're right. I think the whole ecosystem needs to move into that direction. Very, very thoughtful. Yeah. Thanks very much. No panel will be complete without talking about ESG and sustainability, and this one is no exception. We're very keen to hear some views on the developments in that market. And I first want to talk to you on this, Tim, because obviously KfW has been a very early participant in that market. And I'd be very interested to hear, how you're seeing the developments in the ESG market, and whether you're really seeing that they're starting to make a difference and that they're a core component now of the overall financial system.
Yeah, I think they are a core component. If I look, for example, now on the investment and the sustainability financial investments, if alone I look at the PRI signatories, so the principles for responsible investments, we have now over 4,000 signatories. And if we look how much asset under management this means, is over $100 trillion. On the other side, we see a very strong development of the sustainable bond market. The overall outstanding of the sustainable bond market is now round about 1.6 billion trillion. And we see here positive dynamics year by year with new volumes. If we look at 2020, I think we had round about an issuance volume of 590 billion. And if we look this year, I think we're now mid of the year somehow 380, 400 billion. So there's definitely a positive trend of dynamic in here. But what we also see is, from our perspective, we see the trend also to fragmentation. So I would call it green goes rainbow a little bit. So we see new labels like water bond, forest bonds, blue bonds, etc. I think this is something to be watched in fairness. But overall, I think the clear positive message is here from my view is that there's clearly a mainstreaming of green finance in the financial system, or from my view, simple said, if you look now, or any listed company now can really not afford to have a sustainable strategy in their overall strategy. And if you look on the investor side, the investor not only looking anymore on the product, like for example, the green bond itself, they're looking much more on the holistic approach of the company. So very clear with the focus, for example, how do you protect your revenue with regards to the future with these huge transformation processes in front of us. And this is a very good and realistic scenario from that point. And I think it has been mentioned before, regulators play a very important role. I think we see here the, I would say, the harmonization of standardization. We see, for example, the EU taxonomy, and we see what is very important also, harmonization with regards to transparency and with regards to disclosure reporting. So in a nutshell, the trend is there. The trend will not go back. It's definitely part of the financial system.
Thank you.
You're mute, Martin.
Let's pick up on some of those points, and I want to turn to both Julia and Jean-Luc to jump in here, if we may. The ideal, of course, is ultimately that ESG is not something special, it's just business as usual. And that's what we're all aspiring to. But at the moment, of course, when we look at the way the sustainable bond market's grown, and we can all be very happy to see that has grown exponentially, it's at record levels. Last year, it's moving at record pace again this year. But it's still a very small proportion of the overall bond market, so it's not quite yet business as usual. What do you think it takes to get to a situation where it is business as usual? And what do you think business as usual in that context would really look like?
It's a very good question. Tim actually covered some of the things I think that very much contribute towards it becoming business as usual. I've sort of tried to break it down in my head into what are the individual institutional commitments. So sort of at LSEG, we've made institutional commitments to what our emissions are going to be at every level. And that matters, that every institution can stand beside what they're going to say. Obviously, as a venue, we've got a fundamental role in creating the architecture that supports it. But I have always thought about our sort of ESG initiatives as having to be across all forms of the market. And Tim alluded to this too. So it's about sustainable bonds, it's about transition bonds, it's about green economy bonds, but fundamentally it's about green economy marks for listed equity issuers so that you understand exactly what's driving the revenues of those who are listing their equity as well. It's about generating, and we're leading on the Sustainable Stock Exchange Initiative to create much more standardization around disclosures of the expectation for the major centers of liquidity around the world. And so there's all of that architecting that absolutely needs to continue to be built and is already moving at pace. It takes regulatory change. Tim's mentioned the EU taxonomies. The UK has announced a further embedding even this week in the implementation of TCFD and disclosures. I was involved in that when it was for the premium issuers. I'm very glad to see it's continued on for standard issuers as well. And that is, again, about making it just part of the bread and butter of how companies think about the core disclosures that they have to bring to market. But equally, investors need to make demands of issuers and they need the right data in order to do so. And to me, the green economy can only work and green markets can only work in terms of being as good as the standards that are set and the discipline to which those standards are kept. And that is absolutely fundamental. And it means we also can't lose sight of why we're doing this. All of these tests are fundamentally to ensure that as a globe, we get to net zero and we get to the targets we need to by 2050. And every single one of any of these actions needs to be able to be trackable back to that. And that to me is if we lose sight of any of that, you won't get to BAU. The final point actually for me is an embedding piece. I used to ask myself this question at the FCA, and I'm still asking myself this question now, which is when we were thinking about changing regulation to bring in TCFD and make it mandatory for premium listed issuers, then I employed a very large number of corporate finance specialists. Now, did I hire a whole load of climate scientists and teach them to be corporate finance specialists? Or did I teach a whole load of corporate finance specialists to be climate specialists? And if you think about the transition of TCFD, you think about IFRS standards, you think about a natural transition is that we get to a point in time where actually ESG is not so much about a disclosure point, it's an accounting point in terms of the cost of capital and the cost of carbon. And how do we think through the capabilities we need and the embedding of the consideration of climate science through everything we think about through corporate finance. And that transition of making those two languages talk to one another and work together in much the same way that actually everybody's had to learn a great deal more about technology than just pressing a button in terms of actually running institutions. B's very familiar with that. I'm very familiar with that. Fundamentally, B runs a very large technology company that happens to have a banking license. I run a very large technology company that happens to have a license to be a regulated investment exchange. So the reality is that we're all having to gain capabilities and skill sets and mesh them together in ways that we didn't think of having to do before. And that's really how it becomes BAU. It's when all of those things become absolutely embedded and ingrained together. We are on the track to get there. All of these things are getting together. The challenge is standardization and pace at which we agree the standards that we're going to work to.
Okay, thank you.
I
think I'll turn to Jean-Luc for a comment on that, and Ingo, if you wouldn't mind, and then Bear will come to you with a further question. So Jean-Luc, anything you wanted to add to
Yes.
Comments?
I mean, normally I don't have much to add when Julia is speaking, because I've been listening to her several times in previous panels. I think what we need is regulatory certainty in terms of ESG. What I call regulatory certainty, that obviously issuers and investors need to know what they are buying, obviously, and needs to know that the rules are not going to change in a foreseeable future, or certainly not in a short future. So we need to clarify that, but it's quite logical, because it remains a new product to a certain extent, even though we've been, issuers have been issuing for more than 10 years. Obviously SSA issuers leading the pack, but still there is still a lot of normalization to happen. We are talking obviously about the EU taxonomy, EU green bond standards, and all of that kind of approach need to be on the common ground for more market than only the EU. Obviously, I'm talking about the UK, but more importantly, probably in the US as well, and then Asia will have to follow. And we need to have common standard in that respect, because we need to be able to measure the KPI in the very same way. We just need to agree on what measures we are doing. I mean, if we are obviously, I need to speak a little bit of primary market, otherwise I wouldn't do my job. If you take the example of the corporate issuance in 2021 on the green, social, and sustainability bonds, you have already 100 billion year to date of issuance in euro. I'm talking only the euro markets, where for full years 2020 it was 110. So we almost had full year capacity already of last year. And for the FI, it's 72 billion year to date versus 77 billion full year 2020. And obviously, there is another product, SSA, it's 175 billion so far, with compared to 200 billion for full year 2020. So if we continue on that route, we're going to probably double the level of issuance of ESG product in 2021 compared to 2020, which is very impressive. And I think that will be my last comment, is that the most innovative product now is sustainability linked bonds, because you need to obviously define the KPI, and there is a big advantage in that market, is that obviously you're not limited by the amount of assets or how you can deploy the funds, because obviously the fact that they are sustainability linked bonds, you've got your own KPI. And we have a very good example, for example, in the inaugural sustainability linked bond by ENI, which has been done early June. And that's, for me, the future of the market is probably there in SLB. That's all I have to say. I'll leave the floor to my colleagues.
Thank you. Ingo, we've heard from the buy side, heard from the exchange. What about we've heard from the sell side, what about from the buy side? What's your view as an investor?
Yeah, I think there is a broad consensus and everybody is on the same page. So far, I can only echo and support what all colleagues has mentioned before. I will try to bring in maybe another slightly different perspective, not controversial, but another perspective, because finally we are talking about directing capital flows. If you phrase it a little bit more aggressive, it is capital regulation. So from that point of view, I think, and we are at that point, and Jean-Luc just mentioned with his last remark, sustainable linked bonds. I think we have to, and we are in the period now to come in a new S-curve, maybe you can phrase it in that way, which is more pronounced in the direction of transforming and impacting. This is why we are speaking more and more about impact investing. So originally we are started with ESG, then SRI. I think we are now coming into impact investing. And I think that's critical, important in that way. We have to transform something. And that means we have to bring us out of the old, more brown economy into the new, more green or even completely green economy. And I think this transformation means also you have to transform something, you have to partner something. And this is why I think it is critically important to have maybe this slightly different phrasing a little bit more now in the forefront.
That's great. Thank you very much. Moving on to you, Bear. My understanding there from Julia's comments is that you run a technology company with a banking license. So very, very keen to hear about how you think technology is going to play into the sustainability of the ESG space. Clearly, there's a lot of scope that when you look at the absolute scale of the disclosures that are going to be required, they simply can't be done in a mechanical hand way. We've got to be using technology for that. But I'd be interested to get your views on that, please.
Thank you, and thank you, and I kind of agree. Actually, I think I totally agree with Julia's comment about in order to embed what is the ESG agenda into the day-to-day, the process is going to be very similar to the technology transformation that we have seen in the banks. This is going to be about thinking about this always in everything we do, embedding that into the normal day-to-day business. I think that's very important. But look, I mean, when you look at ESG, clearly data is critical for financial markets, and obviously, is critical for pricing climate-related risks and opportunities. And a lot has already been said, right? But I think climate change poses a material financial risk, if I may say, and the financial sector, the firms are actively analyzing what is the potential impact that we will have while supporting our clients and managing the transition. So, we are facing, demands from regulators to put together, and we spoke about it, here the ECB rules and the stress scenario analysis for climate stress testing, as we have seen from the Bank of England and ECB, but more will come. I think we need to make sure that we have good data, that we have consistent data, and that we can, kind of compare across counterparties. I think it will be also very important in order to create new products. How are we enabling, and satisfying the data demand from investors? I think that is going to be one of our biggest challenges. And so, there is a huge amount of work to be done front to back in all the firms that are going to be consistently and globally adopting the ESG agenda, I think. And so, when we look at the capital markets, and when we look at all the issues that we've seen, and the numbers that we've been exchanging here, how investors are going to be able to compare and get comfort with all the new products that are coming out, I think it's going to be really important. And so technology is going to be at the heart of this transformation, enabling it, of course, from a data perspective point of view, but also I think making all the front to back transformation that we need in order to develop this and deliver this agenda.
That's very helpful. Thank you. We're coming to the end of this panel. I think there's one final question. I'd like to just do a quick round robin, and really, I know it's difficult, just answer it in one sentence or perhaps a couple of sentences. And that is, I think we're all on the same page here. We all want ESG to be totally embedded. We all want it to be business as usual. What do you think the biggest risk, the biggest barrier to achieving that is? And I'm going to start with you, Tim.
I would say the biggest risk is that we missed a chance here to really take advantage of that, really, as financial institutions, as development banks, etc., to support here the real economy on the way of transformation. And I think that's so important that we have to be, of course, public sector in the front running, but the whole industry to support here the transition of the real economy and more or less, which goes then in a more sustainability society.
Thank you. Julia, your thoughts?
There's a certain element of making sure no man is left behind, and that we develop the mechanism of doing that transition that genuinely pulls all of the economy through, and does so on a global basis. So one of the things I've always focused on is the risk that we don't all move from a global point of view at the same pace, and run the risk that it doesn't therefore make the same demands of everybody at the same time. And that is a massive challenge. It's a geopolitical challenge, it's an economic challenge. But it is, I think, the only way we get there.
Very, very interesting. Ingo.
I think I have mentioned that before, and coming a little bit from the macro side and the transformation of the economy. I mentioned before, it will come short-term. And it will normally, the normal way is short-term pain, long-term gain. Human nature is often, maybe not always, but often playing the other way around, which means short-term gain, happiness, long-term pain, a long-term gain. And this means, I think this is a little bit the burden, I would say. The burden is changing this human nature into, we have to play it short-term pain, long-term gain.
Thank you. Jean-Luc.
Sorry, I think it's all about transformation. I like the sentence that Ingo said before, that's moving from the transitions from the old brown economy to the new green economy. And we absolutely need to make sure that everybody's on board, and including continent like Africa, who's going to be obviously probably suffering more of the climate change than anybody else. So that's our role, and that's our responsibility as individuals, as financial institutions, to make sure that they are not left behind.
Very good. And Bayer, the last word is yours.
Okay, the risk is that we forget the S or the diversity and inclusion and all of that, and that we are all focusing on only one part of this agenda. And I want to say that that part is also very, very important. And I think, we need to kind of continuously keep the balance between the three, words or the three letters on ESG.
That is a point very well made. Thank you for bringing that up. I'm sorry to say that brings us to the end of our panel. I'd like to thank all of you for fantastic contributions. Really, really appreciate and all the preparation that's gone into this and the time you've made. So thank you very much indeed. I'd like to apologize on behalf of Mandy that we weren't able to organize her connection better. And again, very sorry that you had to put up with me moderating this particular panel. But I'm reliably informed that she is back on and she'll be able to give the closing remarks. But it falls to me now to have the privilege to introduce our closing keynote speaker. And we're delighted to welcome Geir Øyvind Nygaard, who is the Chief Asset Strategist Officer at Norges Bank Investment Management, one of the key global institutions on the buy side. So with that, thank you all very much, and we'll move on to our final speaker.
Dear members of the International Capital Markets Association. First, let me thank the organizers for giving me the honor of addressing this professional audience on this occasion. ICMA is an important meeting point for debt capital market participants. It is of great value that market participants can work to establish standards that contribute to well-functioning markets. Government regulation should not be the only solution to challenges in the marketplace. Norges Bank Investment Management is the operational manager of the Norwegian Government Pension Fund, our sovereign wealth fund. We invest to create value for current and future generations of Norwegians. And we do so within an overall policy framework that secures the validity of a long-term investment horizon. In principle, we invest for perpetuity. Fixed income securities constitute an important part of our asset mix. It diversifies the dominant equity risk, provides liquidity, and in more normal times should also provide a source of income. Resource allocation, the transformation of savings to productive investments, is the main social function of capital markets. We recognize that well-functioning financial markets and an efficient market structure are prerequisites for good economic outcomes and are necessary to achieve our long-term investment objectives. This recognition has led us to engage in market structure debates. We do so in a way that aligns with ICMA's mission to promote resilient, well-functioning, internationally coherent debt securities markets. The COVID crisis has been a huge hit to the global economy. It has changed how we have lived our lives, and importantly, I believe it will change how we will work going forward. Our experience has been that we have been able to maintain quality and productivity while working from disparate locations. Our work life after COVID may become more flexible, less travel intensive, and benefit from accelerated adoption of technological solutions. Yet, while the direction is clear, we do not know to what extent the experience will change how we conduct our business. Other economic effects of COVID can be a concern for a large long-term investor in fixed income markets. As developed economies are accelerating out of the crisis, with both monetary and fiscal policies at full speed, constraints are emerging which some observers link to the heightened risk of future inflation. Yet, while risks might increase, we do not know whether such developments will prove merely transitory or become persistent and pose a more fundamental challenge to our investments. Another fundamental uncertainty relates to the evolution of the market ecosystem. Fixed income markets, which in essence translates economic conditions and economic policy into interpretable yield curves, have become the tool of monetary policy. On some occasions, additional liquidity support by the central banks is required to maintain well-functioning markets. Large long-term investors like ourselves can, and to some extent do, conduct investment strategies that provides liquidity to the market, trading our portfolios in response to supply and demand. Yet, it is hard to see how others than the central banks can secure the liquidity of secondary and repo markets during serious market dislocations. The reliance on the central banks in fixed income markets has become the current normal. We do not know what the long-term consequences might be for the fabric of the market. But acknowledging uncertainty, we should focus on what we can do to create more resilient markets. One key development is the increasing recognition that financial markets should be a part of the solution to achieving a more sustainable economy. At the NBIM, we were one of the first large institutional investors to introduce green bonds into the portfolio. And we have since been an active participant and contributor to the development of the green bond market. An important impact of green bonds may be that issuers have to implement and assess a series of structural changes for their issuance to qualify. ICMA's green bond principles for issuing green bonds does just that. Outlines the process from defining the green projects to the final reporting on the execution. While the broader ESG agenda is ample with ambition, it is the evolution of better data and better disclosure which will make market participants able to make better decisions in line with their mandates. The best way forward then is to move from words to more and better quality ESG data. The uncertainty I have described should not derail our efforts to improve resilience, efficiency, and cost effectiveness of the market. This is done through internationally accepted standards of best practice, appropriate and broadly accepted rules. That is not to say that progress is always obvious. Different market participants may view an issue from opposite angles and provide different perspectives to what is appropriate or what constitutes best practice. When we consider our own market structure initiatives at NBIM, we have found it useful to maintain some principles that we think will facilitate market resilience and efficiency over time. Let me touch on 3 of these. We maintain that sound competition among market participants on a level playing field promotes the broad objectives, and that market practices that stifle competition should be abandoned. We also maintain that transparency in markets is conducive to market quality. Today, with increased digitalization and more efficient use of technology, the benefits of improved market transparency to debt markets might be considerable. Lastly, for a large buy-side institution, it seems that much unwarranted complexity is embedded in fixed income markets. Complexities that provide no utility for the investor, and I would claim limited utility for the issuer, should not be maintained. Surely, efficiency demands that fixed income markets should be structured as simple as possible, yet not simpler. Let me give some concrete examples of implications. NBIM is one of a handful of buy-side members of the ECB's Debt Issuance Market Contact Group, which is currently drafting a report on potential harmonization and standardization in euro area primary markets. We fully support the efforts, which covers the entire transaction chain. Increased standardization, digitalization, and allowing for connectivity to multiple, perhaps competing technologies should facilitate a more efficient electronic workflow than we experience today. Perhaps should particular emphasis be given to streamline and achieve digitalization of the pre-issuance and prospectus process. Harmonization efforts should cover standards and market conventions and include the timetable of the issuance, the duration of the book building, and to a practicable level ensure a transparent and fair allocation process. In Europe, the significance of the EU as a large issuer will increase rapidly over the next few years as the European Commission will fund the next generation EU program through both syndications and auctions. From an investor viewpoint, greater coordination of auction calendar and execution among the EU and sovereign national debt offices will be beneficial. Technical solution may be at the heart of the development of the debt capital markets. The current lack of a consolidated tape of fixed income trading in Europe has important implications. If market participants could assess how individual securities are traded over time more directly, based on a uniform deferral regime across markets, and without aggregation of data that subtracts from the value of the data set, this could be a catalyst for sound innovation in debt capital markets. One immediate and positive implication of increased transparency may be further development of alternative trading protocols, away from requests for quotes and towards more all-to-all trading. More transparency will help the price discovery process because market participants would know much better what spreads individual securities would normally demand in the market. The obvious implication is more competition and liquidity provision in fixed income trading. This evolution should be welcomed by those who value efficiency and cost effectiveness in trading. I have tried to show that working from principles that align well with the ICMA objectives, we arrive at concrete and implementable steps that can improve market structure. To conclude, if you focus on removing unwarranted complexity, increase transparency, and promote competition, digitalization and new technologies may drive us towards more efficient and cost-effective markets that are more resilient to adverse circumstances. ICMA is an important partner at the forefront of that journey. Thank you for listening.
Thank you, Geir. That was the final session of the day. Thank you very much to all of our speakers and panelists today for making this conference a truly interesting and enjoyable event. I'd also like to thank our sponsors and all our members for their continued support and engagement throughout the year. We very much hope that soon we will see a return to something approaching normality and we will all be able to meet in the real world again. We look forward to being able to have our conference in person next year. Thank you very much.